Good afternoon, all. I welcome you all for the fourth session on a refresher course on a wealth creation through equity market, organized by WRC of ICAI. First of all, I would like to thank WRC for giving me this opportunity to be a coordinator of this event. Uh, in today's session, we are going to cover equity market outlook, a fundamental of the equity and the Indian equity market. And without taking much of your time, I request CA Jayesh Kala, Treasurer of the WRC, to address the session.
Hello, good afternoon, everybody. Am I audible?
Yes, sir.
Yeah, good afternoon, everybody. It's really wonderful feeling to have address on this occasion, wealth creation. It's really the talk of the town today, Nifty touching an all-time high on day-to-day basis. And we have experts, Pankaj Tibrewal ji and all other who will be guiding us on this session. We had a wonderful session starting from end of July, and we as our weekly session continued, the run in Nifty also continued. It seems that we had a session on Friday, and every time Monday the market were moving high. This shows the strength of the chartered accountant and the learnings which all our members have been taking through this webinar, and how seriously they are taking, and they are also creating their wealth of their own. The live session conducted by Jitendra Khandolji was indeed a remarkable one, wherein I'm sure everybody would have made money on the live trading session. We can expect much more session from Khandolji, and congratulations to the chairman CA Manish Kadia for organizing this wonderful series on wealth creation. And to all the coordinators, Madhuri Dhanakji, Mayur Mehtaji, Ashita Shah, and all other coordinators who have deeply involved themselves and has worked day and night for making this webinar really a wonderful and successful program. I also acknowledge the presence of my regional council colleague, CA Vimal Agrawalji, who has also participated in this program and has helped everybody for smooth conducting of this program. Thank you once again for giving me this opportunity to interact with all of you. Thank you very much.
Thank you, Jay, sir. Now I request CA Vimal Agrawal, RCM of WRC, to introduce our faculty, Mr. Pankaj Tibrewal, sir.
Thank you, Madhuri. On behalf of WRC, I would like to introduce our today's speaker, Pankaj Tibrewal ji. Pankaj Tibrewal ji has rich experience of almost 2 decades in financial markets. Pankaj ji manages schemes such as Kotak Emerging Equity, Kotak Small Cap, and Kotak Equity Hybrid at Kotak AMC, where he is managing almost $3 billion of equity assets. In his earlier stint at Principal Mutual Fund, Pankaj ji managed schemes like Principal Emerging Blue Chip, Principal Tax Saver, and MIPs. Pankaj ji has been featured in the top 10 fund managers in India for 6 consecutive years from 2016 to 2021 as per Outlook Business. He also featured in the top fund managers in Economics Times in 2016, 17, 19, and 2020. A commerce graduate from St. Xavier College, Kolkata, Pankaj ji also holds a master degree in finance from Manchester University. His hobbies include listening to Hindi music, traveling, and reading. Now I request Pankaj ji to take the charge.
Thank you, Vimal ji, for the kind introduction and kind words. A very good afternoon, all my friends, wherever you guys are joining from. And thank you, CA Manish ji, Chairman of WIRC. Thank you, Jayesh ji, for giving that opening remarks. And thank you all the coordinators, Mayur, Ashita, Madhuri, for coordinating this event. It's a privilege and honor to be coming on this platform and talking to you and sharing the knowledge. And thank you, Jitendra ji, for organizing it. In the next 45 minutes, what I'll do is that in 30-35 minutes, I'll try to cover 3 basic aspects on the markets. One is the outlook, how markets are looking, because everybody is confused with markets rallying. What is the outlook? The second important part which I'll cover is the uh, important themes which are likely to do well over the next 2-3 years. And then we will follow up with question and answer, if any. And if you have any questions, please feel free to post it in the chat box. If the time permits, we'll take few of those questions also. And I'll give my best attempt to make sure that this afternoon becomes a very good knowledge sharing session for all of us. So let's get started without much ado. Let me share my screen. Is the screen visible? Please let me know.
Yes, sir.
Yeah, it's visible. Okay. So friends, yeah. So friends, if you look at the last 1 year has been a historic year in a sense, and it is a mirror of the last 2 years preceding that, 2020, which was 2018 and 19, where just a handful of stocks were pulling up the market, 10, 15 stocks, and everybody was confused what's happening in the economy. COVID, in a sense, came as a blessing in disguise for corporate India and for markets. And look at the performance as on July 31st. Nifty gave you 42% return. Mid cap was almost double of what Nifty returned you, and small cap index gave you 110% return. In this calendar year itself, metals, real estate, IT services, and small cap index has been the best performer. In a way, this last 1 year has created a lot of records, which probably will go into the history books till we don't break further records. What are those benchmarks? For consecutively 14 months in a row, mid cap index has now given positive return, which has not happened for a long period of time since the index was created. The small cap index also on 9 months consecutively has given you positive returns. It's equal to 2004-5, when consecutively 9 months the index gave you positive return. So there's a lot of optimism on the street. There's a lot of euphoria on the street. But let's try and make some sense out of it, that what we as investors should do in these exuberant times. Because friends, don't forget, mistakes are always made at the euphoria stage rather than a downturn. So before we take a call on how markets are looking, I think two things which always on a medium to long term basis drives the market. Finally is the profit of the companies, and second is the cycle of investment, the investment cycle. And if we get answer to these two questions along with valuations, we can be fairly confident on where the markets are heading from a medium term perspective. So first, let's look at the profit cycle where we are. So if you look at the corporate profitability to GDP, which is a very good barometer, and if you look at this chart, in 2007-8, we peaked at about 7 to 8% corporate India profit to GDP as a percentage. And gradually after that, year after year, this number started coming down. And in 2020, we touched a decadal low of 1.6%. It was not that the good companies were doing badly, but what happened, if you look at the light blue line now here, the loss pool, which means the loss-making companies, expanded, and they almost contributed in 2020 to almost 2% of GDP. So good companies were doing well, but the backbenchers or the bad companies started dragging your profitability. But COVID came as a blessing in disguise, and I must applaud corporate India out here. They did an excellent job of looking at their costs, looking at their entire supply chain, making sure the excesses are being weeded out. And I always believe when the car is traveling at 100 kilometers और आपको पता है नट बोल्ट ढीला है, तभी भी आप गाड़ी को रोकते नहीं है. But last April, May, when the car stopped, everybody looked at the loosened bolts and nuts and tightened them. And the result was that when you ended the year in 2021, Nifty ended with a 16% earnings growth, the best since 2004 and 2014. And The corporate profitability to GDP moved to 2.6. Friends, if estimates on the street comes right for FY22, this number of 2.5 should move to 3.5, 4%. So on the profit cycle, you can be rest assured that we are not at the peak of the profit cycle, but we are starting on the profit cycle. Look at these two charts. The aggregate top line growth of BSE 200 companies reported last year and the operating profit is up by 15 and 30%. Not from the last year's level, because last year's base is not the correct base, but from the pre-COVID level. And that's a very heartening sign that the companies have done a fantastic job in making sure they grow their top line and profits. This is a very important table, and look at this March quarter numbers. Corporate India post the June lockdowns, September increased profit, again in December increased profit, and March the top 500 companies reported 210,000 crore of profit, which is the highest ever quarterly profit by India Inc. Who would have thought in a pandemic year and 3 quarters into the pandemic, corporate India will report the highest ever quarterly profits? It's a surprise for everybody. And if you annualize that number, it comes to around 8 lakh 40, and the street expectation for this year is somewhere about 9 lakh. So on a trailing P basis, we are at 23, 24 times. Not superly cheap, not superly expensive, somewhere in between. But the point to note is that acceleration is happening at a very fast pace in terms of profit growth for corporate India. And we believe that post the second wave, though that has been emotionally draining for all of us, we all have lost near and dear ones, but the bounce back of economy has been much faster than expectation, and different parameters indicate, the macro fast moving indicators are suggesting that economy has bounced back quite sharply. I am sure you must have looked at the export numbers for the July month. It's $35 billion, highest in any month ever. And that is a barometer that what corporate India is capable of doing. The second point is, friends, investment cycle. And I think after a long time, maybe 10, 11 years, I think the factors are so conducive for capex cycle to recover. Look at this one. For the last 5 years, corporate India was roughly investing 5.5 lakh crores and was stagnant at that number for a long period. But look at this table. The cash generation kept on continuing, and in FY20 I have not combined the numbers of 21 right now, but FY20 the free cash generation was about almost 1.5 2 lakh crores post interest payment, and that was used to repay the debt. And similarly, the thing happened in FY21 as well, where corporate India shedded excess debt, and across the board when we speak to corporates and analyze them, everybody is looking buoyant in terms of expansion. So I think after a long time, corporate India is looking good on balance sheet, on cash flows. Just to give you some numbers, cement was had a debt across their balance sheet. And if I look at the top 6 cement players in the country, they are now just having 9,000 crore of debt and an annual cash flow of 25,000 crores. Look at steel, which was the most painful sector for last 4-5 years, and we saw many NCLT cases there. Now the annual cash flow is 1.5 lakh crores and the debt is just 2.5 lakh crores. So 1.5 years of cash flow sufficient enough to repay the debt. And I think that has been played across the sectors, and that's very, very heartening to see, friends, that corporate India is in a much better shape. And apart from the nifty companies, when I look at the broader market, I think corporate India looks very good on balance sheet. So I think this is one very important point to note, which will aid our investment cycle. And I'll come to other reasons why we believe capex cycle is looking to change after 10, 11 years, and what are the other factors contributing to it. This is a similar thing. Debt has been reduced in 15 sectors, over 20%. There's a lot of euphoria right now going on in mid and small caps. There's need to be a little bit of caution. But look at this chart, friends. The Indian mid caps and the US mid caps are very closely correlated. And over the last couple of months, you are seeing that in US, the frenzy which was built in the broader markets has started to consolidate and die down a bit. but Indian mid caps and small caps have continued to rally. But over the last 5-6 days, which we saw, in my view, is a bit of a trailer. I think there has been some excesses which have got created, and I always believe that in any cycle there will be drawdowns which one needs to witness, and if you don't have a stomach to digest that volatility, probably equity is not an asset class for any of you. And I think intermediate corrections are part and parcel of any cycle. So what we saw in the first 2-3 slides is that profit cycle is early, investment cycle is just about to start, which gives us a confidence that we are not at the late cycle or a peak of the cycle, but somewhere the valuations are not keeping pace, and I'll come upon that. And Indian and US mid caps, when I compare, and especially the US IPO frenzy was also peaked out, and that is also correlated with India. Last couple of issues we saw that the expectations were much higher, but listing was at a much lower price, and hence we need to be a little careful in the companies we are investing in if we are doing DIY, which is do it yourself. Look at the valuations and every parameter on Nifty price to book, price to earnings, we are slightly higher than the average, and we need to take cognizance of that. This looks to be many charts, don't get confused. Just focus on your bold white line and the bold yellow line, friends. The reason I'm putting this chart, that since the index was created of small cap and mid cap, this is the highest return over Nifty in calendar year to date in any other year. So Nifty small cap has given almost 45-46% return calendar year to date. Nifty has given 15-16% return. Similarly, mid cap has given 35-37% return, and Nifty is again 15-16. So the gap or the spread and the alpha of small cap and mid cap over Nifty has been one of the highest we have seen in any calendar year to date. So the clear question comes that after such a sharp outperformance, is it time to be careful and cautious? Our sense is that tactically, yes, that you need to be a little careful on markets because valuations are running much ahead of time and there's a lot of exuberance. Money has been made easily. आज के दिन किसी से भी बात करो, पूछो क्या करते हो आप, बोलता है शेयर बाजार का काम है, चाहे वो घर में हो, स्टूडेंट हो, people are making easy money. And being a old observer of cycles, I believe that such easy money is never sustainable. And on the hindsight, we know the reason for correction, but normally many parameters gives us indication before, and we are seeing some of them as valuations are going much above and margin of safety is reducing. So Nifty at 16,000 all-time high, what to do? All-time high doesn't mean that the market will crash, friends. I'm not saying that. If you look at the data, even investing at all-time highs have statistically proven to be correct. If you look at Nifty since 2000 till July 21, on an average, the one-year returns, even investing at all-time high has given you 13% return. And 73% of the time, you have got positive return, even investing at all-time high. On a 3-year return, it moves to 87% of the time you move to a positive return. And if you have a 5-year horizon, 100% probability that you will make a positive return, even if you invest at an all-time high. So my only submission is that if you are investing today, make sure you have a slightly longer term horizon, because statistically you will be very well positioned then. But don't get fearful that Nifty at all-time high, what to do, whether to book every penny out of and book profits and not. I'm not saying that, but be ready for a tactical correction. And if you are investing, stagger your investments over the next 3-5 years. Over the next 6 to 8 months with a 3-5 year horizon in mind. Looking at the past cycles, clearly one point which I wanted to highlight was 2006. I clearly remember in May, June, Nifty corrected suddenly by 30% and small cap index corrected by 43%, just on some margin issues. And the memories are still very clear in my mind. And from there, the markets rallied 70% in some 34 weeks and doubled from there as well. So what I'm trying to again highlight by this chart is that in a longer cycle, which is 2003 to 8, we had 3 or 4 very sharp corrections, and everybody thought Gaya market, and markets crossed the highs over the next 35, 40, 45 weeks and made further highs upon that. So this time also, I believe the similar story can span out, that you may have some intermediate sharp corrections, but if you take a block of 3-5 years, I think you should be quite okay in terms of returns. Corrections happens every year in markets. You look at since 1980, I have shown this chart. On an average, 21% from peak to bottom in the markets correction every year. Last year was a casing point. What happened in 2 years happened in just 25-30 days. Nifty corrected by more than 30-35%. But the end result was a happy one, that Nifty closed, despite of 35% correction, 16% higher. Look at 2020, 38% correction, but finally the end result was that Nifty closed at a 16%. And this shows that out of the 41 years, while markets had an interim decline only every year, only 9 years the market ended at a negative returns. So clearly that shows that intermediate corrections are part and parcel of market cycle. On an overall basis, despite longer term, returns have been excellent. I think 14% CAGR growth in Nifty since 1990, if you look at, and I think that's something which is a very, very good return. And funds have added few alpha points better than what Nifty has delivered. And small cap and mid caps have done even better. Friends, I think this is one very, very interesting chart which I wanted to show all of you. And this has helped me over a longer periods of time. Today, there's a euphoria in mid, small, micro caps. Everybody wants to own that. But this chart has helped me. What this chart says that I have taken the earnings yield. And if you all are students and practitioners, you will know earnings yield is nothing but 1 by PE. So just looking at the index P of mid and small cap versus large cap will not give us the correct picture, because there are a lot of loss making companies sitting in small cap index and mid cap index. Just to give you some data, the small cap index has about almost 30% of index from loss making companies, and in mid cap it's about 35%. So just comparing the headline valuation will not be correct, because the loss making companies will make the headline valuation look expensive. So what I do is look at the profitable companies and earnings yield. In 2017, 16, 17, you saw that this spread of mid, small, micro versus large cap became almost zero. So there was no reason to take additional risk to invest in mid, small and micro versus large cap. That in the next 2 years went up to 10, 8, 9%. And that was the time last year to take extra risk, invest in mid, small, micro. But as the thing is, people always flow, kind of stay with the sentiment and the flow, and nobody wanted to invest. But now look at this. We have not gone to the 2017 extremes, but the spread of mid, small, micro versus large cap earnings yield have compressed significantly, which is giving some signs of caution at this marketplace. So be a little careful in wherever you are investing. I could go wrong if only the earnings growth of the broader market surprises me versus the expectation. However, on a 3-year period, if you would have invested Nifty 50, 100 rupees in 2000 Jan 18, you are at 151, and mid and small caps are still lower. So on a 3-year basis, the broader market is still underperforming, but near-term caution is warranted. On a next 2-3 year basis, I think the broader market looks to be outpacing large caps in terms of growth on an index as well as stock specific basis. And we believe that if you are invested in right funds, right companies, which can grow over the next 2-3 years, probably you will be surprised on the return side. So I think if economy continues to show recovery, which we are seeing now, the sentiment being positive, animal spirits coming back, I think broader market has further legs. However, in the near term, we need to be a little careful. So if you are investing, please have a clear horizon of 3-5 years, not anything less than that. What are the themes, friends, which are making me positive, and where I think the portfolio should be positioned? The theme 1 is, friends, big getting bigger, strong getting stronger. और ये हमने देखा डिमॉन के बाद कि ये था कि unorganized will give space, GST compliance will improve, which will make sure formal sector becomes larger and larger. But now that theory is turning into practice post-COVID. Look at this interesting chart, friends. What is happening is across sectors, we are seeing consolidation playing out. NBFC top 2 companies are now on a blue line. If you look at on an incremental market share, 90% of incremental market share between two housing finance companies. Even in banks, which is such a large sector, the top 6 banks are 70% almost of the incremental market share in loan. Cement, top 5 companies are 91%, top steel companies are 90%, telecom same, aviation same, port same, general insurance same. And this consolidation and market share gain we are seeing across electrical cables, tiles, wires, pipes, luggage, grocery, retail, everywhere. So one of our themes which we believe is that go with the leader of every sector. Go the top 3-4 players of every sector and they will not disappoint you across different sectors. And friends, normally people get confused when I say big getting bigger, strong getting stronger means only large caps. No, that's not the case. We did an analysis where we looked at companies market cap 101 to 650, which is a universe of 550 companies. We removed the top 100 companies and made it, as per definition, large caps. You'll be surprised to know that in that universe of 550 companies, there were 200 companies which are category leaders in the space they operate in. For example, a tile leader, the number one guy, may be classified as mid-cap as per SEBI definition. But from a business perspective, he is the leader of the sector. And same thing we can see in paints, we can see in plywood, we can see in consumer durables, electrical cables and wire, luggage, and so on and so forth. So the point I'm trying to drive is big getting bigger, strong getting stronger doesn't mean only large caps. Across sectors, wherever you find leaders, be associated with them and they will not disappoint in the future as well. And this chart shows that if you would have invested with the leaders, category leaders, you will see that they are 1/3 of the best performing stocks in the 100 to 650 universe. And if you had made an equal weighted index of those 200 companies, which are category leaders, your 100 rupees would have moved to 1,000 rupees. So 10 times in 10 years. The second theme, friends, is the industrial manufacturing and private sector capex. I briefly touched upon in my previous cycle presentation, cycle slides. It's the same one, but additional points which I'm trying to tell you is that underlying theme which is playing out is China plus strategy. Every global corporation is looking to diversify their supply chains out of China. And our interaction and conference call suggest across corporate India that export momentum is looking very strong. And today's data on export number of July of $35 billion clearly demonstrates that. So the China plus strategy is clearly playing out. And across the board, we are seeing that export momentum is picking up because of consolidation of supply chains. The second, friends, is the PLI scheme. We saw across last many years many schemes, but this I think could be a new pro-growth template for India's new industrial policy, friends. And don't take it lightly. As per Credit Suisse, if everything goes okay, we could add $144 billion, which is 10 lakh crore incremental sales and 70 billion to GDP over the next 5 years. And that's a large number. Government will shell out 2 lakh crores in incremental incentives over the next 3-4 years, but corporates need to plan capex ahead to avail the incentives. And friends, I may sound optimist, but trust me, in the next 5 years, India will produce 75 crore handsets. And the way the electronic ecosystem is evolving, which was the largest import item few years back, I won't be surprised in next few years, India become the hub for export of mobile phones and ancillary, items. What we are hearing is that after Foxconn, Winston, they have set up the shop. All these ecosystem is looking, whether it be a panel display, speakers, motors, screen, all those global guys are looking to set up a shop and ecosystem in India. Same thing will play out in AC, same thing will play out in LEDs, same thing is playing out in chemicals, same thing will play out in API. And their government has identified 13 sectors for this PLI scheme. I think that's a very, very pro-growth template for India's new industrial policy. Government has done the heavy lifting for all this while. on the capex side for last 4-5 years. I think the private momentum will gain towards the end of this year. Capacity utilizations are high across steel, cement, and most of the corporates are looking to spend a good amount over the next 2-3 years. So I think private sector waking up, government doing the heavy weightlifting already. And the third part, which I will touch upon, is the residential real estate. So friends, if economics you would have all known, the gross capital formation in an economy is comprising of three parts mainly: the government part, the private sector part, and the individual part, which is nothing but residential real estate mostly. And that has been subdued for last 7-8 years. I am seeing early signs, friends, of revival. And last few years, you saw RERA, DeMon, GST, ILNFS, Yes Bank, all those issues creating turmoils in the real estate sector. I think those are all behind us. COVID has come again as a blessing in disguise. We all need, bigger houses to live in, and I think that's something which is creating demand. And across cities, when I am seeing the registration cycle or the registration data, it is very, very encouraging. Also there, 2-3 things at work structurally. One is the interest rate cycle. At 6.6, 6.7%, getting a home loan is a dream come true. Also, the affordability at its best. Uh, Property prices have not gone anywhere in the last 6-7 years. Residential incomes have moved up. So in our index, this is the best affordability index in 2.5 decades. And a lot of people who are sitting on the fence are looking to buy properties across cities. Another point, friends, is a just out of box thought. IT sector today does an export of $160 billion. If in the next four years, if the momentum continues, we'll do $250 billion in export per annum of IT. That's additional $80-90 billion, which means that 45% of IT or 50% of IT cost is manpower cost. So if we create another $90 billion of incremental revenue, 40 to 50 billion dollars will flow to the employees, which will be spent on housing, consumer discretionary, automobiles, consumer durables, and so on and so forth. Also in this sector, we are seeing consolidation playing out. Launches have, by small players have been completely out now. People want brands, people want better names to, put their trust on. So I think that all factors are aiding to a revival. How do we play this? I am a great proponent of ROE, return on equity. In real estate, not too many developers are high on ROE generation because their large part of capital on the balance sheet is deployed on land banks, which are non-productive. If you look at the real estate, I would like to play it through ancillaries, the second, beneficiaries, which is tile, plywood, cement, electrical durables, wires and cables, consumer durables, mortgage guys, and so on and so forth, and paint guys. I think that's the better way to play because they're leaders in their sectors. Balance sheets are strong, cash flows are good. So that's another theme which we are positive on. The theme number 4, friends, is digitalization. And you would all agree that this seminar would have been otherwise happening on physically, but what COVID has done, pushed forward the digitalization across the globe. And every corporation for their business is looking to digitalize. Goldman Sachs is saying that we are no longer a broking company, we are a tech company. Pizza Hut is employing artificial robots for servicing in their restaurants. Honeywell, the industrial company globally, is using the best digitalization to give service to their industrial customers. So digitalization is not only the new age platform companies, but every company aspires now to be a software company, right from food delivery to industrial to a broking company. We all, and a pharma company. We all know that. Indian IT has been an indispensable cog. We were only doing 4 billion of export. We are talking about 160-70 billion dollars. What a remarkable journey without any support of government. I think Indian IT has proved itself, and this has shown that India could do anything. And friends, I think in the next 5 to 10 years, the reason we couldn't become a storehouse of manufacturing against China, because factors of production like land, labor, capital, something was an issue. But if you look at the digital world today, you don't need land. On human capital, you have the best human skills available out there in India. And on financial capital, you have venture capital, private equity ready to fund you, which have flushed with liquidity globally. So I think we have a right to win in this space. And I'm not very surprised that what we did in 3-4 years, we did in 8 months in number of unicorns formation, which we have seen now. There are 100 unicorns. Credit Suisse, again, this report, which is a very interesting report. And the way I look at it, markets, is that there are about $400 billion worth of market cap in IT index. You add the another $20 billion of new age businesses which are there, which is $420 billion. Now the new companies have getting listed to, few weeks back you saw one of the unicorns getting listed at a very high market cap. And with all the public information available, and you look at the data, my sense is over the next 3-5 years, $200 billion worth of market cap can get created out of the new company. Some will go bust, some will become mega caps. We have to evaluate, we have to be agile, we have to be humble enough to recognize that there is a change in consumer demand preferences which is happening. And I think there's a paradigm shift which is happening in investing world, and we all as public market investors should have an open mind and adaptability to make sure that we ride this wave over the next 10 years, which in my view is a very exciting time. Last, I would leave with you guys with a thought that I am extremely positive on this decade on India. You may hear me brush me aside saying that you are sounding too optimistic, but I think there's a very potent combination at work, which is 1 into 1 into 1, which is 100 crore Aadhaar accounts, 100 crore bank accounts, and 100 crore mobile connection friends. This combination is a very lethal combination. If 2 years back I would have said that in 4 to 5 months we could vaccinate 50 crore people out of 130 crore people, and with the needle going in your skin, the vaccination certificate right on your mobile, you would have laughed on me. But the fact of the matter is, it's happening in front of our eyes, that in 5 months with just one Aadhaar card, we could vaccinate 50 crore people across India. And this is no joke, friends. What it shows is that any project, anything we want to execute, it can happen at the shortest possible time. And this is not the old India. Execution will happen. Irrespective of who is at power, my sense is that India can show higher growth rates in coming years, probably which we can't expect right now. And all the foundations, whether it be GST, whether it be insolvency laws, whether it be compliance, other things, those things have been, foundation has been laid strong. Digitalization, Indian stack, digital payments, everything is there. Now we just need the animal spirits, global corporations setting up the shop, trying to take up the investment cycle, and probably will be surprised by the new growth rates. So I'll stop here, friends, and thank you for your patient listening. I hope some knowledge could have been added through this presentation. If time permits, I'm more than happy to take few questions. Thank you for your patient listening.
मिश्रा जी, चैट बॉक्स में क्वेश्चंस कोई आए तो sir, one questions from my side.
Yes, please.
As we all know, there is a shifting towards technology post COVID.
Yes.
And although the shares is also moving ahead of in some companies valuation, what's your outlook on large cap tech companies from here on?
See, the commentary which came out in the recent quarter results is that demand momentum is extremely strong. And let me give you 3 trends which we have seen in the IT companies. The trend number 1, that the demand is across the board. It's not polarized in few sectors or few companies. What we saw in the previous cycles was that either BFSI, which is banking and financials, doing well, healthcare doing well, or high-tech companies doing well. But this time, what COVID has brought to the realization to every industry, that you need to have a robust digital backend system. You need to migrate to cloud over a period of time, and all your system processes should be equipped enough to handle from anywhere, right? So I think that migration is creating a demand democratization, I would say. which is demand all over the place. And that's where all companies, whether mid cap, small cap, large cap in IT, is gaining out of that. So that's the first trend which we are witnessing. So demand continues to be extremely strong. The only problem which I see in IT services today is the supply side. It's a good problem, but it's a problem. Today, India will hire the maximum number of engineer graduates from the campuses. And trust me, the attrition rates across the IT sector is very high right now. You speak to any IT companies, they are seeing 20-30% attrition, which is a large one. At some point of time, it will impact the delivery. Finally, order है, but आपको deliver भी तो करना है. अगर आपके लोग ही चेंज होते रहे और इतना डिमांड है कि लोग 25-30% हाइक में जाने लगे, तो वो एक प्रॉब्लम क्रिएट करेगा. एंड थर्ड, द only other concern is margins. Margins probably are at the peak in my view. From here on, margins will only come down in IT sector. Let's see how companies manage their pyramid and the cost structure overall. But these are the three trends which we are seeing in the IT sector for the next couple of years. But demand continues to be extremely robust, extremely robust. If you have any questions from the chat box, we can take it.
Pankaj sir, I have a question. This is Ashish here.
Yes, please. Yes, please, Ashish.
Sir, how do you see? I mean, I mean, is it the biggest divergence between SME and large caps? I mean, large listed companies and the real economy in the SME segment, non-listed. I'm saying. I mean, there's a biggest divergence right now in terms of their growth, in terms of their this, and India being a very at a peculiar position where the interest rate are the lowest, growth is probably at the lowest for the SME category, and inflation is the highest with the material cost and all the commodity prices rising. How do you see? I mean, the SME would be there, and which is the biggest job and wealth creator, vis-a-vis large caps. So how
Absolutely.
do
you are absolutely right, and a very good question, right? Let me give you my thoughts. This is for the first time that you saw GDP contracted by 6-7%, but earnings growth was 14-15% in Nifty, which is the listed universe, and broader market earnings growth was also double digit. So clearly the top 300-500 companies seems to be doing extremely well, whereas the small medium enterprises are having their own challenges. What are those challenges? Let me take you through. First, on the compliance side, I think post GST, the compliance has become extremely cumbersome, and many small SMEs are not able to cope up with that, and that's creating some kind of market share in every sector, shift from the tail end of the sector or the smaller enterprises to medium or larger enterprises, and that's a trend we are seeing across the board. The second, I think, is the raw material issues, which is relating to working capital. Okay, let me give you a small example. मेलामाइन करके एक रॉ मटेरियल होता है जो प्लाईवुड में जाता है, राइट? एक साल पहले $600 था, आज $2400 है, राइट? And the reason I am choosing melamine and because of plywood, because if you know, north में unorganized bhade pade on plywood, right? And 40-50% of the industry in plywood is unorganized, but they are not able to start because immediately $600 वाला $2400 हो गया. आपको रॉ मटेरियल अपफ्रंट लेना है, आपको उसको पैसा अपफ्रंट देना है, और प्लस आपको क्रेडिट देना है कस्टमर को. So working capital has got elongated. Financial institutions are not funding the smaller SMEs as much as the listed companies. So I think working capital is becoming a big issue because of higher raw material cost and other problems, and led by other labor issues and other things. So I think you are seeing, and digitalization again, I mean, they are not so equipped on digitalization front, system, processes and all that. So they are finding it tough from a delivery perspective. So all these things are leading to market share shift from the so-called smaller enterprises to medium and large. On an aggregate base, I'm complete with you, Ashish bhai, that it leads to lower growth on an aggregate basis. But I'll be a little selfish here because we are discussing equity markets and wealth creation. It leads to that 500 companies creating wealth for me at least and for investors.
Thank you, sir.
Over to you, Madhuri.
Thank you.
Madhuri, you are mute. Madhuri, unmute कीजिए.
Thank you, Pankaj sir. I request the CA Ashita Shah to give a formal vote of thanks to sir.
Thank you. Thank you.
Thank you, Madhuri. Indeed, a wonderful and very informative session, sir. On behalf of WIRC, it is my proud privilege to cast a vote of thanks to Pankaj Tibrewal, sir. So the way you took our participants to the session by practically depicting through graphical charts was really commendable. The way you explained the profitability, etc., has really benefited our participants. Sir, we are very grateful for sparing your valuable time and knowledge with our participants. Thank you very much.
Thank you.
Thank you.
Thank you.
Thank you,
Madhuri.
Ashita.
It's a pleasure to be on the platform.
Thank you.
Okay, before I recognize the presence of CA Manish Chadiya, sir, Chairman of the WRC, and CA Trishti Desai, Madam, Vice Chairperson of the WRC. I request Trishti Desai, Madam, to share her thoughts.
Thank you, Madhuri. I will not take much time. I know we are here in capital market program. It's just that I'm using this platform to broadcast about one event which is coming up, which is the IBC RRC, which we are putting up on, it's starting on 27th of this month. It is going to be at Madhuban Resort, and it's an in-depth discussion and the best of the faculties to discuss IBC provisions, and there'll be a lot of group discussions. I request members to take benefit of this. There are limited rooms available, so I think the early birds will always benefit. So that's it from my side. I just thought I'll just use this platform to convey this message. Thank you, Madhuri. Over to you.
Thank you, Trishti ma'am. We'll definitely join this course. Now I request CA Abhishek Ruya to introduce our next faculty. I request CA Abhishek Ruya, sir.
Abhishek ji, can you unmute yourself? Abhishek ji, can you unmute yourself?
Unmuted, sir.
We can't hear you, Abhishek ji.
Abhishek ji is online or not?
Abhishek ji is online, but his audio is not coming. Video is coming.
सर उनका माइक का आवाज नहीं दे रहा है सर.
Madhuri, you have
Technical glitches. I request Jitu Bhai to introduce our speaker.
Madhuri.
Yes.
I want
I request Jitu Bhai to introduce our speaker.
माधुरी मैडम आपको ईमेल किया मैडम. माधुरी मैडम. सर आपको भी किया ईमेल.
Is it audible now?
Yeah, it is audible.
Please check WhatsApp.
Yes, sir.
I guess the headphones had the issue. Hello. Yeah. I would. Sorry for the delay. I would like to invite. Firstly, I would like to thank Amisha ma'am for coming on board in a very short span of time. We had just told her to come on board last 3 days back only, and she said yes on the spot, and we could just get her on board. So I would like to introduce her. She is the joint MD and a key shareholder in Prabhudas Liladhar Group. She is also a leading woman entrepreneurs and has got many awards also. And she is the leading business channel for also giving lectures on leading channels like CNBC, ET for her views and insights also. She is a chartered accountant, cleared in 1987, joined JM as an analyst. After that, she joined PL in 2000, grow her institutional business into a 36-fold in just 6 years. And after having conferences in 2013, 2003, 2005, then she got her 4 to 5-fold stocks. She also had she also started with corporate advisory business and raised around $1.5 billion during 2005 to 8 period. Under her leadership, she also started NBFC in 2006 and also IB business through PL Capitals Private Limited. She now heads a retail division since 2012 and having also an advisory services where the returns are huge under her leadership. She has also received one of the most respected brands from Asia 2 times in a row now. Total, she has 16 awards. I would like to rather list the recent awards she received in 2021. Women boosting economy during COVID pandemic during the CEO Story magazine. Also, she is awarded as a woman leader in BFSI sector, Women Achiever of the Year, and Business Leader of the Year from World Leadership Congress and Awards. Also, she got Global Women in Leadership Award, GCPIT India Africa 2021. She was also awarded by the Economic Times the Most Promising Women Leaders 2021 award. That's it from my end. I would like to invite Amisha ma'am to start with.
Thank you, Abhishek, and thank you. I hope I'm audible.
Yes, ma'am.
Yes, ma'am.
Thank you, Abhishek, and thank you the entire my CA community for inviting me and giving me this opportunity. I wish I can add value to all the participants who are present. Can anybody guide me? How do I see just the presentation? Yes, I can see all of you. This screen needs to become smaller.
Ma'am, we can see your presentation.
Tell me, Ashish.
We can see your presentation. You just have to scroll that window upside. So you'll be able to enlarge the presentation side.
Okay, because just a second. Give me 1 second, yeah? Yeah, now okay, thank you. So, everyone, I was here when Pankaj was talking about his subject, and quite a few themes which he talked about. Ashu, please keep the presentation and not the screen. Sorry, guys. Just keep this, okay? And don't change it. So I also heard the kind of bullishness that he was expressing, which is likely to see in India. And I will add a couple of points here. And as I have been asked to explain a few sectors little more in detail with some fundamentals, I will try and do that. So as you all can very clearly see, there is miles to go before we rest. As in terms of per capita GDP, we are so, I wouldn't say behind, but there is so much more that we need to achieve. And as per capita keeps growing, the whole cycle changes, that of spending as well as investing in the economy. As most of you know very well, post-COVID also and post little correction in GDP growth forecast, still India will be the best growing economy, even if we take anyone's estimate. for 22. Though my belief is that the real differentiation will start being seen from 23 onwards as we grow. I just wanted to show this graph that initially between 86 to 98, we took 13 years to double the GDP. Then it took 7 years. The key period of 2004 to 2010, when of course world was growing too, and India was also leading with reforms, be it in privatizing infrastructure through BOT, telecom reforms, the first round, and banks being more liberal, we doubled our GDP in 4 years. If you see what happened when we were trying to clean up our economy through many reforms, but whether demonetization or GST, but beyond that, we were trying to clean up Indian banks' balance sheet and Indian corporate balance sheet. And in the process, I think the most required the element for growth, which is money or liquidity, was so scarce that it took us 12 years to double our GDP. And as you can see now, there is a key change, 360-degree change as what I say, which has happened in Indian mindset, Indian, so to say, economy and political mindset after almost 6 or 7 years of this regime, and that is that we took a bold decision in this budget and during this COVID that we allowed our fiscal deficit to go up to 9%, and we also took a statement that it will be not before 2026 that we will return to the original path of 3%. Now, when you take such a bold decision, its repercussion is that during COVID, when private sector was impacted and consumption also was, some other sectors impacted, government continued spending on infrastructure. So the multiplier impact of infrastructure continued to come. And as that base is set with enough liquidity in the system and in the economy, of course, coupled with what is happening globally in terms of printing by Fed and Fed particularly, we are going to see a huge change in what is happening in our economy, and we will see fastest growth in our economy on a very sustained basis is what we feel. These are some of the things which are the base which is created. And apart from the government-led reforms, both on law as well as on digitization basis, the clear one theme which has come out is that the corporate balance sheets are most lean at this juncture ever in the history of India, which is shown by both their debt to equity, their working capital cycle periods, their debt to EBITDA, as also their, in some cases, of course, their return ratios. But largely, that these three parameters, we are the most lean. And so also has happened to Indian banks in terms of their key ratios, like first, their tier 1 capital adequacy, then their total capital adequacy, and above all, their credit cost, which we will cover. So, on a very broader fundamental basis, and why I say these are fundamental factors, because markets is made up of two things. One is earnings, which is decided by these fundamental factors, and then is the multiple which you give because of many factors which are beyond fundamentals. One of them could be, of course, the growth outlook, but second is the liquidity, third is the perception. So right now we will try and cover only the fundamental aspects of the economy and sectors in terms of the growth perspective. So what will help GDP grow faster, and in turn some of the sectors discussed by Pankaj, so I will not go much in detail and I will move forward. So one thing which I would like to showcase to most of you as to how professionals look at the markets. One is, of course, the earnings growth trajectory. Correct. As what we saw, the GDP growth trajectory, which was also constrained in last 10 years, and now going to show a huge growth. Something similar is going to happen in earnings growth trajectory of Nifty EPS, that from almost 15 to 20, we had just 3% CAGR. And this is how Nifty earnings growth each year used to evade analyst projections, and we used to look at one or other factor contributing to it. Now, if you see that the Nifty CAGR, earnings CAGR, to which we give a multiple to arrive at either Nifty, or when it comes to stock, we give a PE to arrive as price target, the growth trajectory is substantially changing. Now, what are the bifurcation? Where is the growth coming from? This could be one interesting slide, a bit more in detail, but very important for investors and analysts to know. One, this slide shows you within Nifty what is the weightage of each sector. If you see, banking and financials have almost 38% weightage. Now this of course covers leading banks, NBFCs, but the weightage is so high. And so the major change in earnings in this sector leads to major change in earnings for Nifty 2. Then the second highest weightage is of technology, which is almost 17%. So between just these two sectors, we have more than 50% weightage. And this is all weighted average based on free float. Nifty is a free float index. This is the kind of weightage these two have. And if you see the kind of growth, that growth in 21 for banking universe is about 18%, for 22 projected is about 35%, and next year is 23%. Similarly, if you see technology, that growth trajectory is changing. So for 22, some part could be because of last year's 1 quarter loss. But when the sustainability continues in 23, you see that the sector is in growth trajectory. And this also tells you that some of the other sectors also where there is huge delta. And overall, it says, for example, metals. I will treat metals a little differently also. Metals, if you see, for 22, it is showing almost 120% growth. And for telecom, for 23, it is showing almost 100% growth. Now, these are the key indicators based on which we go deep dive into the companies to select based on which sectors where we see there is a huge growth. There are certain compounders like agrochemical, where if you see the growth is 23, 29, 31, 20. That means the growth is very steady and sustainable. Now, some of the sectors I will touch base with and share the key triggers or key drivers as I see, which can help sector do well, and of course, I believe that the stocks will do well. So key things which are changing as far as banking is concerned. One, of course, as what we say, that the banking is the bed on which India economy plays, which means if any sector, whether SME, MSME, micro, large corporate or retail, any sector starts showing pain, the reflection comes in banks, as that is the nerves through which the credit is given. If you see what has happened, that there is a linkage between GDP growth and credit growth. Because of the kind of changes which we went through in terms of NCLT, so first time Indian corporates knew that the bank's money is to be returned, it is not there for good, and the ownership can be changed. Now these two are such a big mindset change. If you ask me 6-7 years back, nobody in India could have ever believed that this can happen in India. And so when we went through this phase, most of the promoters said, I don't want to give my children a balance sheet which is with debt. So India went into a deleveraging phase completely. And when India went into deleveraging phase, the GDP multiplier of the credit in the economy corrected. Not only from the perspective of credit growth, also from the perspective of capex growth. And last but not the least, everybody started focusing from bank's balance sheet perspective to NBFC and in turn retail. These were the only two which were really growing. So we saw the emergence of large NBFCs like Bajaj, who is ready to fund average Indian from telephone to TV to fridge to now even a sari through Amazon, and everything else that you want to buy, they chip in to tell you, okay, within you cannot pay. I mean, if you want, you don't pay now, you can pay over 6 months. But that entirely was getting financed through these technology-led NBFCs, and the core banking, which was assessing the projects and so on and so forth, was deleveraging. As we move forward, we feel, and I will connect one more point here, that while the India balance sheets were getting corrected, the highest pain was seen in banks' balance sheet. As you can see, their gross NPA ratios moved up substantially during this period of 18, 19, 20, as we started showing up, as also the net NPA ratios. But as we move forward, the fresh slippages are coming down as shown in the next chart. And with that, the maximum write-off which happened, when you do write-off of any bad loan, it reflects in your credit cost, as you see in NPA credit cost, which peaked in 18-19, and then the graph is going down. So which means that we went through this entire transition, and it reflected not only in our credit cost, but when your credit cost, which is your provision divided by your loans, goes high, definitely your profits come down. So your ROA, return on assets, keeps going down. And so you don't have enough capital generated to sustain your growth. So what you do, you dilute. So you get hit as investor on both the counts. You don't have a good ROA or ROE, banks dilute, and they don't have enough capital to grow. We went through this phase. As we stand now, and as we see how things are panning out for future, banks have braced themselves up with phenomenal tier 1 capital. For example, banks like ICICI Bank are at 17% capital adequacy. Provision coverage ratios are ranging around 70% plus. Going forward, slippages are likely to come down substantially, as can be seen in this chart, and also credit cost. So the bank's profitability will keep going up, and according to me, this will be aided by the capex story, which is shaping up in India and likely to unfold over the next 5 years. So I feel this space, which took all the pain of India's cleanup, is here to do very well in next 3 to 5 years. As usual, the micro fundas of choosing the dominant, efficient player for appreciation, for investments in stocks would continue, but this is from sector perspective, is what I think is happening in banking. The next important sector which will completely, according to me, will turn around is capital goods segment. Is what we understood, that from promoter mindset of fear to banks mindset of cleanup, combined with huge imports or no import barrier, made capital goods scene in India for last 10 years absolutely flat. If you open any balance sheet, I mean, if you open any 10-year screener on some of the leading companies in capital goods, for example, LMW, Praj, or Triveni, you will see a very flat top line. And when that such flat top line happens, their employee cost keeps going up. So percentage of employee cost to top line keeps going up, and you keep feeling pain in the bottom line. Now, what is really changing so substantially in capital goods segment? If you see, this chart is able to explain us how the phases emerged in India and what are the key aids which help capital goods segment. So when there was an up cycle in capital goods segment, there are few factors which converge. And whereas the down cycle, there are a few factors which converge. Now the way we stand, we see commodity prices across the board strengthening, which means all commodity players after a very long period, be it cement, steel, aluminum, but these are just the large sectors. But someone just mentioned about melamine some time back, and so on and so forth. So as commodity sector starts making money, now commodity sector growth comes only through capex. You sell either 3 lakh ton or then you sell 5 lakh ton. But 3 lakh ton you keep selling, you can't grow. So the moment you start making extraordinary money, you have desire to start putting that extra capacity. So we think that strong commodity cycle is one of the first aiding factor for capital goods growth. Now that is being strongly aided by, as what we discussed, the infrastructure push, absolute and strong resolve to continue to give push to infrastructure by government. That will also substantially aid capital goods sector. And beyond that, PLI scheme and China +1 strategy, which is most of the global boards have adopted. These confluence of these 4 factors will lead to phenomenal time for capital goods company. Just to give you little examples here. And this is one more concept, but just to give you a little more example. For example, spinning, cotton spinning, such a basic thing where India is reasonably large. But if you see last 8 to 10 years, we were hardly making any money. The spinning cycle has changed because some change in China's policy and the fact that they don't want both this yarns to be exported beyond a point. The moment that there is a global shift, the spinners here have started making money. Similarly, as you know, steel have started making money. And the leader, say for example, LMW, it is a 65% market share in India, despite all global players being present in spinning. And last 6 to 7 years, the top line is flat. As all the spinners start making money, they will start spending both on repairs, debottlenecking, brownfield, and I feel ultimately greenfield. So this is how the chain will change. And some of these capital goods manufacturers, how they operate, they first take order, then they take your advance, then they start manufacturing based on the materials that they order, based on your order, and on every milestone they collect money back from you. So the business is very beautiful. With growth in top line, it does not need more capital or dilution. So when this segment turns around, the wealth created is also enormous for investor perspective, and of course the multiplier impact in economy in terms of employment generation is also phenomenal. Apart from the top four points which I explained, which is about the commodity cycle turning, balance sheets to be very good, and the China plus one plus PLI, there is one more important thing in from perspective of the companies which has happened, and that was also again India's one of the biggest reform, which was making India most attractive in terms of tax rates. And a little calculation here shows that the change in tax rate has released or created savings in the hands of corporates of almost 1.6 trillion rupees. And reduction in interest rate has created further savings in the hands of corporate. So total savings of corporate tax rate plus interest rates is almost 2 trillion rupees. Corporates indefinitely will not continue to sit on cash as the demand push continues and there is a cut on imports or a barrier on imports, and they see this trend being sustainable, which we see now with the proactive government policies. The capex cycle will unleash, and as what they say that everybody wants corporates to become aggressive again, and which we think that will be the next 5-year story in India, aggressive capex from private sector. This is also to some extent explaining that which I just explained to you all. Now, two sectors which we took are totally domestic focused, largely also dependent on domestic policies, which is and domestic economic health, which is banking and capital goods. Both have gone through their fair share of pain, and I feel over next 3 to 5 years they should do very well. IT is a very different ball game. This is totally linked to what's happening globally, and this is India's place of pride in the world, where we have done remarkably well. But up till now, we always thought that now IT services is a matured industry and more like an annuity business with low single-digit growth. We feel that that thing is changing. Couple of things are happening. Apart from the fact that our IT outsourcing is continuously improving, which means globally more and more outsourcing is happening. Domestic companies' penetration in that outsourcing market is also continuously going up. One important chart I would like to show here. Of course, tax spends from bank and retail are very important for this machine to continue, which is the outsourcing and in turn orders or business for our IT sector. This is one sector, one chart, which shows percentage of companies by industry with 6 essential digital capabilities. Banking and financially globally, which has been the largest spender, even as of this report, has only 18% end-to-end digital customer experience capability. This is the largest spender and it has to do so much more. Retail, which we all know is led by e-commerce, still the overall retail's end-to-end capability is only 39%. And because of this chart and the penetration we see, we realize that IT industry is a normal age-old, 20-year-old IT industry will, from a mature stage, post-COVID and post this disruption which is happening across businesses and sector, will go through tremendous growth. The momentum in deal wins will not stop. And I, for one, believe that when the business is there, for me, you, or world's largest corporations, and then they want to be in the fray, they will not mind spending or paying little higher if for our Indian IT companies, the cost of retaining employees go up. So I feel that margin will not be at a big threat with growing top line and growing outsourcing, which means instead of on-site, the offshore will continue to grow. And this chart gives me tremendous comfort that this growth momentum that we are seeing will continue for long. Of course, because of which now analysts are changing, which is of course not our today's subject, but I'll quickly touch upon. Now analysts are changing. And earlier we used to give a different valuation, which is just a PE, but now you can give a DCF. When you give DCF, which means you feel that the sustainability of this business is very, very long. And once you give a DCF, the prices from here on also continue to look very attractive. These two sectors, because of need of time, I will not, lack of time, not take too much in detail, but I wanted to touch upon because it's very important. While banking, IT, and capital goods have their own fair share, consumption is the outcome of all that is good which is happening, be it in digital space with Instagram. You would say why Instagram is linked to consumption? Because if you ask me, Instagram, earlier Facebook, and so on and so forth, all social media is the key driver for personal consumption, be it from a leisure or sports shoes to sports dresses to makeup to new phones to new cameras to vacation bags. All this is driven by social media enormously, because always this new picture trend creates a FOMO and a desire to do. And this is leading to substantial improvement in consumption. So the earlier way to look at increase in consumption was, of course, through paid ads. Now we don't even need to do that. This has now become a viral thing in the millennials, and I don't think we are also any less in doing so. Apart from this, the digital penetration, smartphone penetration, which is leading to consumption growth, there are a few other important enablers of consumption growth. One, of course, being the Zomato and Swiggy to deliver at home. The second important pillar, which is more old economy driven, and that is the Pankaj was also explaining that the new income from IT sector impacting and positively having its impact on residential real estate, and in turn generating more demand, be it for tiles, fans, pipes, wires, switches, and this will continue to roll. And this will be very domestic driven. So consumption across these sectors, I feel, is going to have a big multiplier impact as some of the infra and capital goods, IT also do well. Last but not the least, the entire bedrock of our digital emergence as a nation is on telecom. 4G, 5G, data, so on and so forth. But we have never seen this telecom companies' profits growing. They've been investing and investing, be it on towers, be it on 5G auctions, as India is the lowest cost data economy. But imagine we are the lowest cost data economy and we are the most consolidated telecom economy. Now these two tells me that future will not be same. Future will just not have for these telecom companies only volume growth. I feel it will be supported by very handsome price growth, and all these years of underperformance in profits and overperformance in capex will now lead to a next 3 to 5 years of period when we will have phenomenal profit generation from these companies. So telecom is the another sector which I think will do very well in next 5 years. I'll just quickly touch upon one example of a sector which we call it tactical sector and not core, as we discussed the first 5 sectors. What happened in chemical industry in last 5 years with changes in environment policies of China? You know, I think will substantially and absolutely repeat in steel. This is what happened to all the chemical companies in India, where this is stock price CAGR, and of course the sales CAGR is looking little muted because we have taken 21, and 21 is an impacted year with 1 quarter almost being lost. But if you see, the stock CAGR is phenomenal, and so also at many places the profit CAGR in a sector which was totally forgotten. Now you see this. What's happening in steel? What's happening in steel is the fact that we have to reduce carbon footprint. One of the largest manufacturer, like China has out of 1200 million, almost 900 million produced in China. So the largest footprint is from China. As they've adopted the agenda to reduce their carbon footprint, the chain of decisions happened. One of them being they don't want to export steel. They want to produce for themselves. Now, China was exporting almost 23% or 25% of their steel, which was almost 40% of European requirement. Now, with this decision, you have seen the steel prices skyrocketing. So we are at a juncture when there are two lobbies. Is this steel prices and steel stock prices here to sustain, or we will go back into slumber being a commodity? I feel that this trend is here to stay. And I would also highlight here one point. If you see here, this is analyst projections, and this is very interesting to see what broad analysts think. If you see at most of the places, the profits, whether it is EBITDA or it is adjusted PAT, for all the top 4 companies for 23 is lower than 22. And that is what is reflecting that quite a large portion of analysts feel that these prices will come down. But if I see these basics, I feel that Europe will take very long to take up new facilities or new capacities. China will not budge the way they did not budge in chemical in a hurry to create carbon footprint for their countries and in turn export to Europe. This is not going to get solved in a hurry, and in the process India will continue to benefit both because of remunerative prices and because of basic raw material that we as a country have both coking coal and iron ore, and I think expansion with us will be very good. So what will happen is that if you see what is happening to their debt from 97,000 crore debt in FY20 for Tata Steel, it will come down to just 35,000 crore. And net debt to EBITDA will come down, if you see in next table, from almost 5.6 to just 1. This shows the kind of change which will happen in their balance sheets. With reduced assumption of prices in 23 by street, as we call, or analyst at the moment. But if prices do not correct so much, they will be almost in a position to do more expansion as well as reduce their debt. I feel steel will be in a very sustainable cycle of profitable growth. Having covered a few sectors where I think next 5 years will be very good, I will not look at these themes in detail because I think Pankaj covered it, but these are the key emerging trends in the economy. E-commerce, as we all know, including people at my age, have now become very comfortable to order on Nykaa and get things home. So this is a trend which is well set not only in millennials but also in other age group. EV, which is just emerging, but over this decade will be the most important change. OTT during this COVID, we all experienced, we did not miss theaters at all. We kept watching some of the best shows in the world or made in India, sitting in our own comfort of home at our own convenient time. And this trend is here to stay. Green energy, as you all know, will be an unchanging theme for a very long time, be it in India or globally. Solar or renewable in different forms will continue to be driving the energy scene. Of course, Make in India is not as global a theme, but it is more an India theme. And last but not the least, in terms of technology, health tech, edutech will be the two key themes which will keep emerging and growing in India. Now, I tried to cover a few sectors for today's session, and the nitty-gritties of that sectors as to how we think it will lead to profitable growth for the companies within that sector. I think it was useful, and with this I will end my session and I'll be open for any questions that you all may have. Thank you. Ashu, can you please change it to the other screen?
Thank you, Amisha ma'am. I request CA Ashish Bhatt to give a formal vote of thanks to ma'am.
Good evening, ma'am. On behalf of the entire CA fraternity and the ICI, I would like to present my vote of thanks. Ma'am, in such a short span of time of 45 minutes, you have covered the entire macro and micro and connected both the dots. You have covered the entire ESC model of analysis, like the economy, sector, and the company in such a precise 45 minutes. You've been able to do it. Thank you a lot, ma'am, for imparting this knowledge to us. Thank you, ma'am.
My pleasure, absolutely.
Thank you, Ashish. Now I request Regional Council Member CA Chintan Patel to introduce our moderator and the panelists for the next session.
Thank you so much, Madhuri. It's really privilege to have the eminent faculties as a part of speaker. Let me first introduce the moderator, because moderator is person who is going to really take care of everyone together. So we are having along with us Yash Jain. He is a senior correspondent from CNBC TV 18, having spent more than 5 years with CNBC TV 18. He has covered various topics. With respect to sectors that includes insurance, personal finance, stock exchanges, and many other sectors. And he has been also associated with various financial regulators like SEBI, IDBI, PFRDA. So I'm sure when Yash Jain is as moderator, it's going to be one of the most important and interesting panel discussion. Not taking time further, I'm moving further to next part, that is another faculty which is panelist in this particular panel discussion is AK Prabhakar. He has been tracking markets for almost 30 years, has experience in the Indian stock market since 1991, with expertise in generating wealth, creating ideas and long-term returns, using a combination of multiple study identity sectors and stock which can outperform market in next 2 to 5 years and 10 years. Presently, since 2015, head of research in IDBI Capital Markets and Securities Limited, handling a team of 25 people tracking different sectors plus people to track market data. Frequent appearance on business news channels, including frequently quoted in all the business newspapers and digital platforms. He has won India's Best Market Analyst Award from Zee Business for the year 2012. Sir, we all are waiting to hear from you very important tips as far as the stock market is concerned. Coming to next important panelist is Prateek Agrawal. He is a business head and chief investment officer. He heads the PMS and AIF business of ASK Investment Managers Limited. He works closely with channel partners and provides strategic direction to fund managers and research teams. He holds over 27 years of experience in capital markets with a long, distinguished sell-side research, investment banking, and advisory experience, which has been a great asset on the buy side. Prior to ASK Investment Managers Limited, he was associated with SBI Capital Markets as head of research and headed equities at ABN AMRO and Bharti Aksas AMCs. Welcome you, Prateek Agrawal ji, for the panel discussion. And now coming to the last and very important profile of Vikram Kotakjin. He is the co-founder and managing partner of ACE Lansdowne Investment Service LLP that acts as an investment manager of the SEBI registered category 3 alternative investment fund. Mr. Kotak has over 25 years of experience in financial markets across segments that include fund management, fixed income trading, and corporate finance. He has successfully set up businesses and teams in equity and fixed income segments and scaled them up significantly. A key erstwhile member at Dutch asset management company, Mr. Kotak served as a chief investment officer, equities, responsible for advising over 1 billion assets in equity through Indian domestic funds, India dedicated offshore funds, and allocation funds. So we have a wonderful experienced panelists along with us, and I'm sure that with so much experience on capital markets, every member is looking forward to have understanding from you, and most important, the tips how the market is going to happen in the future, and is it the right time to invest or not? Is it the top or is it going to come down? I think a lot of questions are there, but yes, with the panel discussion going to happen, all are going to be through. Now I'm handing over charge to coordinator Ashita Shah.
Thank you,
Yes,
Jain.
are you
Yeah, Madhuri, please take it over.
Thank you, Chintanji. Now I request Yash Jain sir to kindly proceed with the panel discussion.
I think there is some technical problems while joining by Yash Jain sir. So till the time he is joining, I request, starting with Vikram Kotak sir, plus sir, share your views in our topic, Indian equity market, a growth story, what's from here on. So sir, starting with you, please share your initial views on the topic. विक्रम सर आप अनम्यूट कीजिए. विक्रम सर, you are mute.
I'm sorry for that. I'm actually in a remote location, so sorry for that. Thank you, Jitu bhai. Thank you, everyone from CA fraternity. Thank you, Prateek and Prabhakar ji, all our friends and colleagues in the system. I will try to kind of summarize, or maybe I'll try to talk about the couple of emerging theme, which is likely to drive the new generation of stock market. Because like Prateek has spent 27 years, Prabhakar has spent 30, I spent 25, 26 now. So we are actually kind of, I can say, a couple of decades of experience, and I'm seeing the new generation. Let me start quoting with my neighbor sons at the age of 20. He's the guy who bought Burger King at 125 rupees on listing day and making a lot of money. Okay, so today he's sitting at 175. Bought, his father gave him 1 crore rupees, and he actually went and bought Burger King. Now the idea is that he's making money, no doubt about it. 122 has become 170, whatever. So he's actually plus by 35% in just 3 months, which actually can surprise Prateek and me and a couple of us senior fund manager, that how it can be possible that someone who in the age of 22 just left the college and start making profit. I had a good time chatting with him on the how did you research Burger King? What exactly you did in the Burger King? His simple summary was that Burger King owns the global franchise, India Burger King, and that's how I bought the company, that all the global profit will come into the Indian company. Now that is such a big misnomer, that a guy who has bought a 1 crore worth of share really doesn't know what is the company all about. Do they make profits or loss? They they even don't own India franchisee, but he's thinking that they own the whole global franchisee. It's MNC. So I think, people are making money, markets are allowing it to happen because of whatever, thanks to COVID and the pandemic, which allowed people to have a lot of time and a lot of money at the perusal. So India is a place of the opportunity. We have almost $600 billion of money comes as a saving every year. If you ask me or Jitu bhai or Prateek in earlier years, what we used to do with the saving, we all used to tell people, bhai, your asset allocation is very important. So you have to first put your money in FD, put some in gold, put some in bond market, and come to equity. That is a learning we had in our time. Today that money is also available. Also, people are over-invested in real estate and bond and gold kind of asset. And equity, if you always see 3 or 4% investment from Indian retail investors. So today the $600 billion saving pool is anyway available. What is top up on that happen is people got a lot of time. Because of WFH, you cannot move out. So one, you have more time, so you can do the easiest way to open is your screen and just start kind of, and if it's a profit making, why not carry on for a long period of time? That's a point number one. Second, you also saved a lot of money because you didn't travel, you didn't went for holiday, you didn't use a car. So all this money is available at your perusal to invest somewhere else. And the third most important point is you entered at a time when the markets were fallen, March 2020 or April 2020, where you available was everything was cheap. So you started buying at 8,000 or 9,000 index, and I think last 1 year Indian mid cap index up by 90% and something like that. So I think these are the 3 or 4 factors all combined together and made people to come in. Having said that, the question comes: is structural, or is it structural, or it's a one time? My answer is structural. It's not going to be one time, because people have started kind of investing. It's going to be structural. But the biggest caution here is that it's not easy money. If someone spend a whole day to earn say 500 or 1,000 rupees, how can a people make 30-40% continuously for over next 5-10 years by just investing into shares? So I think there are a lot of learnings, a lot of experience are going to be. Yash is already there, so I'll kind of cut short my talk. But summary is that people are right now in a hunky dory, or I can say la la land. But I think the sanity will come. People will start learning, because once you lose money, then you learn. People don't learn without losing money. So first you have to lose money to learn and get the experience of coming to the market back. So I think right now it's, as I told you, the guys buying stocks like anything. I know one more guy, a 24-year-old guy, who is trading 16 hours a day. So I asked him, how do you do 16 hours a day? And I'm talking about IPL time. So he says, morning to I do stock market India, then I do commodities. I do Nasdaq and Dow Jones, and also I get time to play in IPL. That whatever that Khelo India Dream 11, I don't know what the sites are, but I think this is how people, the new generation, is actually panning out, which is a big worry to me. And I think with the time passes, the sanity will come. I'll stop it here to let Yash lead the whole talk.
आ रहा है ना? नहीं ये फोन में नहीं, आप मेरे लैपटॉप में आ रहा है.
Summary is that we have to kind of take this on our stride. A lot of retail money is going to come, no doubt about it. It's a structural move. You see number of DP accounts opening, number of trading volumes changing from institution to retail. But I think people have to learn a lot. It's about sadhana or puja. It's not about trading. It's about how do you really learn the fundamental or underlying of the business rather than just watching a TV channel and decide what to buy or something like that. So that's my view.
Over to you, Yash.
Okay, sir, of course, apologies for getting connected a little late. This is new for all of us. But what I wanted to understand, and this is an important question that I want to start this discussion with, and that is that making money in the equity market is one thing, and creation of wealth in equity market is one thing. Now, in terms of literal sense, you would say that it means the same thing, but in terms of practicality, these are two different concepts and with a lot of difference. Mr. Kotak, tell me, how do you differentiate between these two concepts, and how would you ask today's investor to position himself to be on the side of creating wealth and not just making money?
So you perfected my second answer, which I stopped because you came. So it's a perfect point of topic. I think my differentiation part will be very simple. That a guy at a 22 college dropout got money 1 crore from father and putting to Burger King and making money and not knowing what is this company all about or what are cash flows or what are the opportunities all about, just investing because someone has told him. That's a one way of making money. The wealth creation is all about sadhana, as I said. It's about worship. It's about learning the subject. I know Prateek for many years, and we have spent so many years spending time on research, meeting companies, understanding the business models in detail. So spending time and taking the profession, or I can say whatever you want to do, you need to spend a lot of time on that. I mean, you cannot make money. You can make money just by a fluke or a chance or participating in the rally. But to get into consistent mode, which is the most important part, that how do you make consistently that money, which ultimately makes you into wealth creation zone, is where you have to spend a lot of time, a lot of research, a lot of learning. So you have to actually take as a profession. All of three of us or you, we all take this as a profession and then we build on that. So I think there's going to be a big differentiator. But having said that, we are going to see a lot of craze, a lot of accidents, a lot of newcomers which are going to create a magic. We've seen Zerodha or many more companies just out of the wood, and they actually built a really large scale enterprise and a very, very valuable enterprise. So there's no question about it that we are going to see this momentum on. India is just what 0.4% of the market cap is digital. Look at the US, it's 30% market cap at digital. So opportunity in front of us is fairly large. But how do you manage the risk part of it or learning part of it is going to be the biggest driver going forward.
I think what Mr. Kotak said, we have a very popular saying that form is temporary but class is permanent. And this sort of sums up and fits into that saying perfectly. I want to come to Mr. Agrawal and Mr. Prabhakar. A lot of people listening to us are millennials. They are talking about investments in equity markets day in and day out, especially today when markets are at all-time high and there's so much of frenzy about markets. Both Mr. Agrawal and Mr. Prabhakar, what would be your tips as far as today's investors, the millennials, are concerned, to ensure that they are on the side of wealth creation and not just making money? Both of you.
No, let me share my views. Is my voice reaching you?
Yes, absolutely clear, sir.
So, this happens. It's happened in the past. Today an old man says he has made money because he invested in Coca-Cola because he was drinking Coca-Cola. And we know the old man. So, the millennials of today, they know what they are doing. We try and study what they will do. They are doing different things from us. And chances are, if they invest into what they do, and there are just so many of them, it's like a baby boomers kind of generation in the Indian context. Chances are they will over time do well, learn while they are doing it, and their experience could be vastly better than ours. And I will give you a few things which have changed. I mean, if we go back 20 years, what were the kind of companies that were there in the market? Let's set the better. People, put their Malabar Hill houses and as equity and raise money on that, and obviously, we all know what happened after that. Since then, many things have changed. Regulations have tightened. The quality of businesses which are there in the market is very different from what was there, let's say, 20 plus years back. So the chances of success for our new generation is higher. Second, a lot of times education, etc., is brought to the fore, saying, 14% of Indians invest. Do they know where they are investing, etc., etc.? Well, close to 50% of US guys invest. And we all know they don't do maths. They can't do maths. Shocking, right? Which is why they send all their software here. So the point is, our guys inherently, this if investing requires understanding maths, understanding, putting 2 and 2 together, they have a much better chance versus people elsewhere. What the West had in their favor was good regulation, so that the lousy companies are not brought into the market, and exemplary, penalties if somebody tried to play hocus pocus, so that the governance standards kept on being high. And second, the overall thought process, that making money is good, it's not bad. And, the central bank would also embrace that. Central bank, while making policy, and I should say this, keeps an eye on the market itself. It is not so surprising that you get 10 days of market drop and a central banker comes and comments. I mean, he has no business to in the Indian context, right? So increasingly, the same things are happening in this country as well. So my whole thing is, yes, go, where your heart is, learn, start small, make mistakes, which is the only way you will learn, like Vikram said. But be more confident. This is a vastly better market than what we as a generation encountered.
Correct, Mr. Agrawal. Of course, what you're saying and what Mr. Kotak also said, make mistakes, but make a mistake only to the extent that you survive to make another one, right? Mr. Prabhakar, again, coming from you in terms of, sort of the same question, what would be 2 important tips from your side when it comes to an investors of today's age is concerned, where, and importantly, I want to bring this point also, where investor who's investing into the markets today, maybe he's not giving his full time to the markets. He's working, he's doing his job. At the same time, he's looking at wealth creation through equity markets. How does he position himself and make sure that his investment decisions are right and he's conscious of what's happening in the markets?
I will tell you one thing. Investment cannot be a part-time job. No, even when we do a full-time job, we make a lot of mistakes, and after so much a year of experience also we make mistakes. Why I'm saying this is, there is a lot of change which is happening. Before lockdown, when Zerodha came, the kind of growth, Vikram sir was talking about Zerodha, the kind of growth Zerodha has seen, it surprised everyone. But there were beneficiary of Zerodha. That is where we need to dig deep into it. You will check the exchanges which are listed, the CDSL which has given 3 times return from there, and the number of accounts CDSL has opened in 15 months. Now that is a major surprise. So every act has a surprise element also. Today I was reading one article which talks about Ola e-scooter, where he will manufacture almost 1 crore. That means he will disturb the existing two-wheeler manufacturer. So there will be few industries which can go out, and there will be somebody who is not meant to manufacture two-wheelers, and he will be manufacturing two-wheelers, and he will be the biggest manufacturer in the globe. So there are always negative and positive surprise in the market, and this is something we need to see. See, when I started my career, MTNL was there as a Sensex component. No, today we say it is a penny stock. No, there were so many stocks, which was there in the Sensex, and we don't find a mention about it today. So things change very fast, and we need to change fast. That is what we need to understand. Anybody who has disturbed the market has not come from the traditional way. Now today, we are talking about Liladhar. He was not in brokerage, for 30 years. He suddenly came and he has taken the market. Now we are talking about Vora. It might disturb, it might not disturb, I don't know. And you talk about iPhone. No, they were not into phone manufacturing, but they disturb the market. So somebody from outside, relatively new people can disturb, and that is something, a major risk. So that is where I'm saying a part-time will not work. No, we need to be dedicated. We need to understand the pros and cons, because the market is vast, and there are few sectors which are we don't need to apply much of our brains, and it will have their own growth. They will have own advantage. But in many sectors it is not so. Somebody will from outside, relatively new, can disturb. We have seen Kodak, which was the largest filmmaker, going out of market. So and all the television makers in India, Onida, BPL, Videocon, they have disappeared. So who was a leader at one point in time might disappear. So we need to understand this market is always dynamic. We need to understand this dynamic, and if we can regularly do our study, then we will sustain. We will make our returns.
Correct, Mr. Prabhakar. Of course, this market, as you said, is always vulnerable to disruption, and somebody's loss in this disruption is somebody's gain at the same time, and investors need to be sure that they are on the right side when it comes to this. But we are also experiencing a fair bit of disruption when it comes to the temperature of our own markets, right? The average age of investors is reducing drastically. Talking about this year itself, we've seen possibly the best numbers when it comes to new investors coming into the markets and trying their hands for the very first time. In that sense, starting with Mr. Kotak, how do you assess that particular trend? Do you see it as a risk which is larger than what we may see the benefits of it? Because this the new set of investors hasn't really seen the kind of disruption or the kind of volatility this markets could have, and they are loose hands, so to say, at this point of time. Do you see that as a large risk for the markets?
No, yes, I don't see that as a risk, because as we always discuss, India is a large population, large land of opportunities, and also as a percentage of savings. When I talk about $600 billion pool in a year, the equity savings were minuscule 3-5 years back. As a percentage of saving a direct equity investment, 2-3%, and if you add mutual fund, it'll be 7-8%. So actually speaking, that number was very low in the parlance, whether you compare US or any the European market or even Chinese markets. So I think India is more underinvested, worried. There are a lot of issues in the past, like I think Prateek rightly mentioned, that the corporate governance, the government. So I think there are a lot of things which are obstacle, even the internet, because we didn't have that kind of app for internet 10 years back, 15 years back, to really know. Now today, 27% of Zerodha IPO applicants are below 25, and these are all app driven. So you look at the way things have changed. The technology is a big enabler here. One, the awareness increases, the data available so easily, and fourth, as we said, that markets are in the zone where things have only seen upside, they're not seen downside. So I think there are 4 parts of it, right? And one more part which is very important, which I mentioned before you came, is people also have a lot of time. So today you don't have to go to office, so you save your commuting time. your WFS, you can do your side activity along with that. So I think that's a new learning of new millennium which is starting with. You don't have holidays, you save money on holidays, plus you don't save time. So there's so many things which are helping this market right now. So maybe one portion of the market may be a temporary or short term, like Prabhakar said, that people, if they don't spend a lot of time on this, they end up doing mistakes and finally they get out of the market. But majority of the chunk, in my view, will remain here. What number of people we are seeing in the CDSL the last 15, 20 years data is 3 crore 60 lakh account, and almost 70% accounts are open in last 2 years. So I think that numbers are going to be here. The volumes are going to be here. The institutions are actually thinking today that how this retail is really taking the big share of the volume also in the cash market. And it's actually a situation like Korea. If you know South Korea, when FI used to buy and retail used to sell, the market used to come down. And when retail buys, the market goes up. So I think we are seeing actually that scenario right now in India. You look at last year, FI sold $20 billion and markets went very differently. So I think this is more structural. People want to look at a new asset class. People are invested heavily into real estate and all other traditional asset class. So I think you will see this startup ecosystem or digital economy or this new sectors which are adding to the country, like food delivery or online insurance. These are all things are going to be part of the future. Only everyone has rightly said that how do you do your good homework and what kind of risk appetite you have. I think that's where I think the whole differentiation will happen. But I'm seeing this more structural, not very risky to the market.
Mr. Prabhakar, first to you quickly, do you see this shift as a more structural shift, new age investors, and more importantly, staying in the markets, not just coming? Or do you think that, of course, right now we are a part of a bull run where everybody wants to participate, but of course the strong hands will stay in towards the end of it?
Now, when I started my career, I was also 20, almost 2021. So, I came as a young boy into the market only. And we need to understand it is not only me, whole set of people came and we had Ashad Mehta boom those times. And, we played that and we lost money post that also. We have seen all these things. But, as a young person, when you lose money, you have a good learning. That is what both panelists have said, and I agree with them. As a young person, losing money is not bad, but you have to learn from why you lost and the reason you lost. So always I say you just write it down. What is the reason you invest? And when you lose money, what is the reason you lost the money? If you can understand both these things, then your future is secure. So if you can understand what is the reason, and when you lose also what is the reason, then I think that these people can become a great investor over a period of time. So I don't think the market, sometimes when we see today's earning, market looks very expensive. But if I look at 5 years, 10 years down the line, it looks very attractive also. So it is what you want to see. But as a trader or a very short-term person, I think everything is built in, and there is always an element of risk or element of negative surprise.
Okay, we've spoken about the demography that we are seeing in the market so far. I want to understand something, and I want to talk about how we are not getting to see a very broad-based participation in terms of geography of the country when it comes to the equity markets. Of course, someone rightly pointed out we have almost 7 crore accounts being invested into the markets, but we just have about 3 states, Maharashtra, Uttar Pradesh, and Gujarat, contributing 50% of those 7 crore accounts. Come on, there are India has fair bit of other industrial states in terms of demography support as well. Why aren't we seeing good amount of participation coming from other states? Who's to be blamed? Is it the regulator? Is it lack of awareness? What do you think, or who do you think is the culprit here? Prateek, you?
No, this is the data that I am seeing for the first time, and I was thinking while you were talking on this. To some extent, Maharashtra and Gujarat is where the equity culture has been, and that's no surprise. We all know that people in this part of the country are way more equity savvy than others. So here the volume should always be looking high. UP is a big surprise, because UP, barring a Noida where there are lots of tech savvy young guys, rest of UP, for me to believe that suddenly the equity culture has moved up there is a surprise. But yes, UP is a large state, the largest state by population. So maybe that is swinging numbers a bit, and maybe presence of Noida, Ghaziabad kind of territory. I think we should see this data adjusted for population, and in terms of my experience, my connect with my kind of investors. Yes, I should say that we are finding more equity investors in a place like UP. UP used to be down and out real estate market. Cash was the king, real estate was what those guys invested in, but now I must say there is a welcome change there. And similarly, I would say even in the southern markets, there is a huge change towards equity. Maybe not all of it is towards listed equity. Maybe a considerable part of it is also towards unlisted equity in terms of venture funds and that kind of stuff. But equity culture, if one speaks of, then it has definitely improved in this country versus earlier. And I do believe it is structural. Earlier, somebody in my team had joked that, debt used to give equity kind of returns and equity used to give debt kind of returns. Now that has gotten corrected. Now interest rates have fallen, and for people who want to make even double-digit returns, have to be invested for the long term in equity. And I think that is really causing this change to take root. Either bring down your return expectations considerably, or take some equity bets.
Okay, Prateek. Of course, we've spoken to Prateek about the issue of not being able to see a broad-based participation. But Vikram, I want to understand from you if that is the case, if you're not seeing a lot of other states really coming into this equity cult and creating wealth in true sense for themselves, then how can the regulators, how can the government, how can market stakeholders, including exchanges, look to change that? Because of course we have a problem in our hands, but what would be your understanding in terms of ways in which that problem can be changed, or at least a start can be taken?
I think when people start making money, they start finding the ideas and find the opportunity. And I think today the media, even the exchanges, even the mutual funds, and the whole community as an investor class is doing a lot of work on financial literacy. And I'm seeing a lot of benefits actually come to the mutual fund industry in terms of SIP. When you look at SIP data, it looks much more broad-based than what we discussed. And like Prateek rightly said, the South market has been a perennial investor. They are investors for 30, 40 years, and they're not. I've seen people in South who are like doing the SIP for last 20 years and 25 years and not change their mindset. So South has been a very steady investor base, but as rightly said, it's a more migrated population in Mumbai or the Maharashtra and Pune. So you find a lot of people actually even migrated who are made money, who are at a very high salary, are living in the financial capital of the country or surrounded. But I'm sure that with the technology, with the awareness, with the literacy which is playing out, and more player like Zerodha in the system, I think this will be a homemade theory that finally people will start looking at this at some stage, maybe in a different form. I'm not expecting, and I don't want to see everyone coming and trading to equity market. I'd rather tell people to go to mutual fund or the PMS or something like that and go give it the money to the expert rather than you spending whole day doing trading and all that stuff here. But I'm going to see that this change is going to be finally percolated across the basket of the country, depend upon the per capita and the size of the market. You cannot expect more from Manipur or Assam, but I'm just saying that a culture also will play a lot of role. But I'm going to see this trend is going to change over a period of time, and it's surely going to happen. In the early days, I think we've seen a 1 year of rally in India. So it's the early days, and जब पैसा बनता है तो कोई कहीं से भी आदमी को पता चलता है कि ये 50 का बन गया था, तो let's move to that market. So I think I'm sure that this is going to happen.
I'm sure, I mean, money, or in that sense, wealth creation, the idea of wealth creation does get a lot of attention from every corner, and hopefully that gets a lot of participation as well. Mr. Prabhakar, I want to understand the same thing from you. You said you've spent about 20 years in the markets. You've seen from where we were in terms of awareness of equity investment, wealth creation through equity investment, and where we are today. There is a significant amount of growth that we are seeing in terms of states where there was no equity culture at all, and today there is significant amount of penetration. But what should be the strategy for the next 20 years, because that's where it will make all the difference for the people who are coming to the markets right now today? What do you think should be the strategy for the next 20 years?
See, the data is, what was discussed. I want to make a point there first. Now, see, in South, people are now risk averse. Previously, they were in direct equity. Today, they have gone to more of mutual fund, as Mr. Vikram Kotak has made a point. So, no, they have been invested for long. So, maybe the demat account might not be reflective of the investment which they have made. So, there can be something different. But when you make investment call today, we need to understand that sectors or sectors which can grow at minimum 12 plus CAGR is very important. So now, for example, I will point out a sector. Now, private life insurance in the last 17 years, it has been growing at 17% CAGR. So even if it grows around 15% CAGR, this is one sector to look at. And it has a bad news, because the number of claims due to COVID first wave and second wave, the number of claims has increased. So that is where they are in bad times. Maybe once the vaccination, we have crossed 50 crores of vaccination. Once these things stabilize, I think this sector is likely to grow for next 10-15 years, as many people will come into the ambit of insurance, even your pension scheme. There are multiple things which can happen. So we need to identify sectors like that, where over a period of time it will create returns, and over a period of time we make money also. Like that, there are multiple sectors which can give us that kind of returns. This is one example. Exchanges is one where I think, as more people come into the system, see, whenever a country has crossed $2.5 trillion economy, now to get into the 5 trillion was the fastest. Now, we have seen US, China, and Japan, and we are in that sweet spot. So very soon we will be a $5 trillion economy. Whether by 2025 or 27, I don't know. But when that happens, even your per capita income is going to double, and there will be a lot of people who will be coming into the system. So in 5 or 6 or 7 years, you will have double of what we are doing today. Let it be in your demat account or exchanges or in life insurance, everything. So that means if it doubles in 5 years, it is 15% CAGR growth. That is what we need to identify. And if we can look at few things which can have that kind of growth, then I think even if a correction comes, it doesn't matter. In 2008 we had a mega correction, but you look at the stock, because of correction, if we are afraid, today people would not have made that kind of return. You check Titan or any stock, even in the correction they corrected, but when they rallied, they gave better returns than the index also.
Correct. Mr. Prabhakar, of course, you gave investors, a lot of new investors, a head start in terms of how they should start their investments, what sectors to look at with the kind of economy that we have in our hands right now. Mr. Agrawal, on the same point, it's literally like we've pressed the stop and start button on the economy due to the disruptions which came through because of COVID. Now, of course, there would be new players in terms of sectors that would do well in this new economy. There would be some sectors, maybe their relevance would have reduced drastically to what it was. In your sense, in this new economy that is rebuilding itself after maybe the disruptions of COVID, which are the sectors or the areas that you would want or that you would advise investors to look at who would really help India to build that new economy again?
Sure. So let me divide it into what listeners may do for themselves and what we are doing today for our investors. Uh, you know, if you are wanting to invest on your own, I have seen a much higher degree of success with people who are investing close to their own experience profile. So if somebody, for example, is working in a pharmaceutical industry, chances are, and with a CA kind of a background in the CFO office, chances are he will know much more about the pharma space than many of us in the professionally investing world. Similarly, for somebody who is in the cement industry. So, if you are investing in these spaces that you should know much more about, you find the trends, the trends. I mean, to the details, ki truck kab gaya, kab nahi gaya, kind of stuff. You will probably do quite well. The next is look at what your close friends are doing. So you have three Daru friends and three belonging to different industries. That is your ecosystem, and your chances of success in investing on your own would be way higher. And versus monkeying around in the market and throwing darts. Throwing darts, you will be successful for a brief period of time, if at all. In the end, it will average out to zero. If you are lucky, you usually results in a loss. But if you stick to what you know well, if what your friends know well, and you speak to each other, then I think the chances of doing well increases. At least that is what my experience has been with my friends and the people that I have seen over the journey. For everything else, so if you are able to invest into three sectors, very good. But for everything else, it's a better idea to give it to professionals. Because as Prabhakar was saying, themes change, valuations change. No 5 years are same as the next 5 years, kind of stuff. So people need to move with the times for sure. Now coming down to what we are doing in today's context in our portfolios for our clients in the COVID kind of time frame. So yes, there are parts of the economy which are damaged, and well, our senses they will stay damaged for a long time. What COVID has done really is to accelerate the move away from unorganized to organized, and even within organized, from smaller organized to larger organized. So you look at the data, I think CMI brought this out, of 3,000 ex-financial companies, and you will find that the top 900 companies are really doing well. The next 1,200 are just about turning the corners, over the last 1 or 2 quarters, and the last 900 companies are still bleeding badly and need all the helping hand that the regulators may provide. So yeah, they will stabilize, they will come back. That is what is being attempted. But the idea is that be with the leaders in the emergent spaces. That's one. And where is it happening? Unorganized to organized shift. It is happening in spaces like jewelry making. It's happening in spaces like footwear, etc. Is something that we are focused on. The other big thing that we have seen is China plus one. The West has created a Frankenstein in the shape of China. It now understands that it needs to diversify its sources, and China plus one is a new acronym that they have floated around. Now, that doesn't mean that everything will come to India. We started to flex our muscles way before time, and they would probably not want another China to happen. So they will go and look elsewhere for everything else. Electronics, Malaysia, Thailand, maybe something else. clothing, Bangladesh, Sri Lanka, Vietnam, etc., etc. But when it comes to two industries, which is chemicals and pharmaceuticals, well, try they may, but there is no other place other than India which can supply them quality pharmaceuticals and chemicals. World, if you look at chemicals, we are 3.5% of global supplies. The demand is increasing at 3% odd. If nobody else in the world wants to make them, then theoretically Indian industry could double every year. We are, as we speak, doubling every 3 years because that's the time it takes in the country to put up a capacity. So this is one space that has definitely gotten a higher percentage weightage in our portfolio, pharmaceuticals and chemicals. The other is, of course, tech platforms and IT services. Clearly, cloud is the way to go. The COVID has accelerated it. In the West, we believe they are tech savvy. They are not, but they have been sleeping, and they suddenly realize that they need to put stuff in the cloud. And suddenly, digital services, cloud services are in very high demand. And we are reading stories about IT services professionals getting large wage increases, etc., etc. People unable to find people to put on the work. So this is clearly another space which can do well in the interim. It's not like a 5-10 year kind of a story, the high growth part, but yeah, versus an 8-10% compounding that we saw in the past in terms of revenues, maybe we could see 10 to 12%, and with luck, maybe a percent higher over the next 4 to 5 years. So this is something that we are again focused on. And lastly, if I may add, so we as an economy are very low on manufacturing. Okay, we now are getting a lot of import duty protection versus just 5 years back. When import duty protection was scarce, and WTO and its rules were really progressing. Now I should say the march of globalization because of COVID has been halted. To some extent, it has been reversed. Every country in the world now wants to make itself great, which basically means get back manufacturing. And everybody understands when India wants to manufacture more for its own markets. And, that is giving hell of a lot of breather to our industry. Government has also rolled out PLI schemes, which are providing a big shoulder to, I would say 140 odd companies overall, of which 70-80 may be listed, so one can take their own pick. The government is doing selection for you. It never happened in the past. So for the first time, government is doing the selection for you. Mostly most of them would be of a quality better than the rest, ability better than the rest, chances of success hence better than the rest.
Okay, so what I understand from Mr. Agrawal is the couple of themes that he's pointed out to us. One somewhere fits into the space of this unlocked trade that may take place once economy starts moving again. The another one is China plus one in terms of the sectors where to the world there is no other alternative but to come in India and manufacture in that particular space. And of course, the third one, as you rightly pointed out, and which to me is also the most important advice, that is you speak to someone who's got a skin in the game when it comes to investments, who knows the sector, knows the companies, and really understands better than anybody else. Of course, Mr. Kotak, I can't put this question to rest without coming to you. How do you view this unlock theme? Because we've got several companies who've literally not been able to participate in this strong market rally that we've seen, and for the right reasons, because this underlying business hasn't really worked well for them due to the lockdown conditions. How do you specifically view this unlock theme that we are expected to see? And under this theme, because since the theme is very large, what would be those couple of pockets or a few pockets that you would specially focus on where you would see a revenge a purchase, a revenge comeback from the consumers?
Sure, that's a good question. I think I agree with Prateek and what Prabhakar said on the exchanges or broking or IT or pharma. I think it's looking like a great theme. But one thing which people are today talking about is the alternate energy or EV or electrification, green electrification, solar. I think it's not a new thing. It's there in world for a long time. Wind power has came in India long back. It remains. Solar came long back. The prices fell. Industry shut down. And I think again because of the global movement and thanks to Mr. Biden coming in the power, now all again talking about climate change and all that. So I think one area which is looking more hot for everyone today is EV, solar. But people are, in India, people are not experienced with that. So I think there's going to be a lot of investment, a lot of failure, and very few successful people will come out on that. The buyer theme for that, in my view, will be metals, because whether you want to remove, want to be a green or whatever, finally, to make a solar equipment or green electrification, you need, copper and aluminum, right? Without that, you cannot even make that panels also. So finally, that theme, whether you like or not, this theme is going to remain here. So metal, as an open up theme, as well as the new economy theme, will always be a byproduct in the world. Second, nobody's invested in last 25 years in a metal in a big way because of worry about the green theme and all that. And also China was a pretty large manufacturer in the metal, and they used to dump everything to the world at whatever prices. Now in China for last 5 years has been kind of revisiting their own goals. They're cutting down their exports. They're cutting down their overall kind of need. So I think metal will remain in the work for some more time. I know it's a traditional theme, but still I think the metal will be the one theme, even in open up and the world economy picking up, and also new experiments with a lot of market cap created around it. People have to invest finally into this new theme. But I'm very worried about the quality of players in the basket and the disruption. I think someone talked about Ola Electric. You'll see a lot of disruption. So I think going to be a lot of write-offs in this sector, but by sectors which are going to have a short demand, because scooter may sell or not, but the parts of scooters or the copper or the all these things will be part of that. So I think that sector will continue to do well. Second, the capex theme in my view, because again, world, and if you look at US itself, the last 40 years they're not invested into seaway systems, big way, transmissions, towers, piping system. So $1 trillion capex of US, which is just approved, is a big opportunity for the world. And this is not happening in the US. Europe also on the side has been spending a lot on capex. Germany, you see the data, the capex theme is again revived. Japan is spending a lot on capex back, and India, which is actually underinvested in the capital goods side of it, will see a large opportunity going forward, because you will also be a part of the world capex story. So I think capex as a theme will be, I know valuations are expensive in India right now, but capex as a theme will be one more opportunity for people to participate in a correct way. And last, when you say open up trade, I think like we've seen PSU Bank at one point of time leading the lending business, then private bank came, and then NBFC came. I think there are great chances that all these micro fintech companies will start creating the niche in the baskets of the districts or the states or the particular segment. I think that's going to be a big opportunity. It's not very easy to play that market, but I think that's a one area to watch for a micro fintech kind of opportunity. Thank you.
Okay, so of course, from all the panelists, we have certain themes which they like, and they would, of course, want investors to look at these themes. Of course, all investors do consult your financial consultants before taking any decisions on your investments. But I want to speak and move slightly away from pure equities and speak about another asset class that, of course, gets traded on the exchanges, that is REITs and InvITs. We've been in the Indian markets. This instrument has been introduced. It's been sometimes SEBI's doing its bit or trying to do its bit time and again to make it more accessible in terms of reducing the lot size, in terms of bringing in more liquidity. But somehow this instrument hasn't really made itself popular amongst the retail investors. How many people do we hear talking about REITs, investments in InvITs, so on and so forth? Mr. Kotak, to start with you, where does the problem lie in this ecosystem, starting from the companies to the instrument to the investors, and what needs to be removed or changed in order to create more awareness of this product?
Sure. I think 2-3 points before I'll just more little digress from REIT to the retailing of the bonds and government security. I'm in the fixed income market since 1996, and I've seen SEBI or government or RBI has been trying this for n number of time that let's start retailing of government security. People should buy zero coupon bonds. People should buy some corporate bonds. But that has not been successful. The reason behind that is the awareness, the literacy, which is what the biggest factor which impacts. And also people don't understand this complicated coupon calculations and what my yields are and all the stuffs are. And also we've seen some past scams in the bond market and all that. That also kind of shaken the confidence of the investors to some extent. Coming to the current scenario, you are in a bull market where the returns are very fast. You apply to IPO and you get 30, 40, 60% kicker. People to go into the detail of the REIT and understand, I think it takes some time. I don't think so we have done enough education side of it on the REIT of the InvIT side of it. Also, quality of the sponsor on the REIT and InvIT is important. Luckily, most of the qualities on the listed one are good. But you will also find a lot of people coming and joining that sponsor REIT segment, where you're very careful in terms of what are the final owners and how this agreements between them and the rental owners are structured very well. So there are a lot of fine-tuned things you need to really work on, which I think is not easy to really reach out or transmit out to the retail investors at the last end. So I think it'll take some time. It's a matter of the market opportunity. And as we discussed earlier, that wherever people find the opportunity and the returns, they'll try to kind of get there quickly. Like I've seen tax-free bond as one segment where people have been over enthusiastically applied and they are holding for years and years the tax-free bonds segment. It's a small segment, but people have done investment. People hold till maturity. They like this tax structure product. But I think REIT InvIT is very good step, good starting. It's good for institutional investor today for sure. But ultimately, finally, it will take some time to transmit it to the last man standing on the street. So it will take time, in my view.
Okay, Mr. Agrawal, do you think the efforts so far have been are sufficient in terms of what the regulator could do from the regulatory perspective?
In terms of REITs, I think if interest rates stay low, REITs will come into very sharp focus. I can tell you it is already happening in the HNI segment. So, Vikram spoke about doing asset allocation into equities, debt, real estate, gold, etc. But, I can tell you in terms of our own house, REITs are now part of asset allocation for yield investors. Now, there needs to be some correction in the manner in which REITs are sold. I mean, there are 2, 3 which are listed, to my mind, gave a very, very meaningful yield versus what is otherwise available in the market. But, people need to educate on what happens if you put $100, do you get your $100 back, or it is only the cash flows every quarter that you get, and how does it work? So some amount of learning on that is necessary, and calculations to that effect. So a 12.5% on a 100 rupee investment that you will not get back, how does it look versus where you will get that back? That kind of thing needs to be taught, but otherwise, I really believe for the more informed investors who are looking for yields, REITs are any which ways gaining share of the wallet. And REITs are, yes, listed on the markets, but at the same time, there are many private ones which are also happening, which don't get listed on the markets.
Correct. Of course, these were a few sectors that we spoke about, but one theme, so to say, which has overshadowed possibly every sort of investment currently in the market is this IPO cult, or the primary market cult that we are seeing. I mean, as someone who covers IPO, there is not a single day which goes without hearing about some DRHP, maybe more than a couple of DRHPs on the same day. Mr. Prabhakar, I want to understand how do investors really approach the primary market? And I'm going to put context to my question. That's because, of course, out of the many DRHPs which are being filed and the companies coming on the D Street making a debut, I'm sure there are a lot of good businesses which need growth capital. But at the same time, in this rush, there are a lot of businesses which may not really want growth capital or do not have scope, but it's just being driven simply because the private equity wants an exit out of the company, and hence IPO is the route which these companies are taking. How does an investor really differentiate and make that call in terms of what company to go for? Is it the management? Is it financials are no more a determining factor? But how does one really look at and differentiate and take a call in this scenario?
This is going to be very difficult. I will tell my personal experience. So, no, I have been investor before I came to market in 1991. So, no, I have attended one company which is recently relisted. I have gone to the AGM. It used to happen in Music Academy in Chennai. So they used to give this big tiffin carrier, for which we used to attend as a college-going kid. My father used to take me, I used to go. And suddenly their company delisted. Again, it is relisted now, and people are buying it happily. And one more company, has raised 4,000 crores, where nothing is going into the business. Promoters are happily selling, and we are happily buying. So, whether that business will create that kind of profit over a period of time, I have my own doubts. So we need to understand the dynamic of the market. So one paint company which got listed recently, it is the 5th largest, but you check the valuation, it is more than the market leader. So I don't know when that kind of growth, whether they will generate, whether they will have the growth which they saw in the initial period. I have my doubt. So Kotak sir was mentioning about one company where it came with a result. It has 270 stores. And the young kid thought it is a US listed company, and they are saying they will become 320 stores by end of this year, full financial year, and then by 2026 they will become 700 stores. See, when you expand, break even takes 2 years. So when you have that kind of expansion, when they will make profit is something I don't understand. Maybe Prateek sir or Vikram Kotak sir should explain when they will make profit, and whether company which is making loss will give us some return. At what point of time is something I don't understand. We need to be very careful. IPO is not for a retail investor. I'm telling you, this is going to be very bad. Today you have a euphoria, everything is running up, you are getting a listing gain. You check, Biocon, which was listed in 2008 or 10. It took 10 years for somebody to give returns to the investors. There have been multiple cases. In 2007, out of 100 IPOs, today if you count it, only less than 30% have given positive returns. 70% has eroded investors' value. So IPO is not a game where a person who is not in market, who is serious in market, can make money. So there are good IPOs. I'm not saying that. There are good IPOs, but equally there are more bad IPOs also. So where PE investor selling at a very high premium, that has become the order of the day. So we need to be very careful, and picking and choosing without reading the full business model and other things is very difficult. Even for somebody who is full time, we will make mistake in IPO. It is better the company list and we listen to the management about 4, 5 or 6 quarters in the con call, then take a call. Somebody with a DRHP, I think I cannot make my decision. So even after 30 years, it is very difficult to take decisions just by what they say in the initial public offering. I take my time to invest, so I am not a person to hurry, and I tell my people also, today you have a listing gains, that is it. Not more than that. So don't go again and look back at the company. Let the company speak out for at least 1 year or 1.5 years. Then we will take a call on buying or not buying the company. That is more important. You cannot take a call based on what DRHP they file. Few DRHP are very interesting. They say we will not make profit for the next 10 years.
Correct. It'll be very interesting to hear the reply from Mr. Agrawal and Mr. Kotak on this thing. First, from Mr. Kotak, I mean, how do you really look at this particular conundrum where there is a lot of money which is being made right now in terms of IPOs, but who knows for how long. Right now there's a euphoria, everybody who's putting money in any IPO is making money. But do you see this as a sustained way of, let's say, investments or even for the listing returns from retail investors?
Listing return, definitely not for sure, because listing returns are part of the cycle. We are in a bull cycle, so everything looking very great, very nice. But we've seen early 90s also, in 2000 in the tech boom also, that anyone who puts the name tech can be sold and can be made money initially, but finally we've seen the result. But coming to the one part which I think someone mentioned about, that we grown from $1 trillion economy to $2.5 trillion economy, and now we are moving toward $5 trillion economy with a lot of adjustment post COVID, which talks about digitization or cost efficiency or many more sectors which are opening up, like food delivery or online insurance, online broking. I think there is enough opportunity, in my view, or enough space for a lot of company to join the bandwagon in Indian equity market. And how many of them are great management or great financials or great work they are doing in terms of corporate governance and quality of earnings, is really going to see. So I think it's again, we have to look at the IPO wise situation, that how this IPO and what are the, key USPs or the strength of the company, and then you can build on that thesis based on that. But you'll always find a good apple and a bad apple in a cycle where everything is looking so rosy. So it's a buyer beware, in my view, Yash. And I think opportunity is huge. We cannot say that IPO is a kind of is a one-time exercise. No, it is going to be here. A lot of promoters I know who has been building a business for 30 years, 40 years, now realizing that we need a growth capital, and when we want to kind of beat or compete a country like China or other countries, and we are at a particular path, I think there's going to be a huge amount of opportunity in IPO. But yeah, you have to be very, very careful in selecting what is good and bad. And I agree with Prabhakar that even 70-80% of the IPOs may not be extremely good. It's all about 10-20%. We should pick and choose and stay invested for a long period of time.
Mr. Agrawal, in a space where experts find it difficult to pick the right ones, how do retail investors, in terms of, and it'll be better if you can tell us and the investors a few things that as an exercise that they can do to really pick those 10-20%, as Mr. Kotak pointed out.
Sure. So I'll repeat some bit of what I have already done. A new IPO once again is a business at the end of the day. Look at it if you know something about it to start with, or a close friend of yours knows about it. I mean, works in the ecosystem, so have some sense on that. But let me put out a few pointers. Look at it this way. At the time of the IPO today, most of the companies, very high percentage is a very good quality business. See change over what we used to see in the past, and you could do, every 5 years what kind of companies you were getting. So the quality of business has definitely improved. What is of much bigger this thing is at what price it is being made available. And there again, the regulator has come in and put in some safeguards. So there is an anchor book, and long period investors do come in and buy in that book. It has a bigger chance of getting an allocation. A price gets found, and similarly there is an institutional bid. Price gets discovered in that manner. And the way the IPO thing works in the country, nobody gets lower than that price. So if a retail guy decides to invest, he is investing with those institutions. So, one, you can try and understand the business itself. So that may prove easy to some, difficult to some, but the other way is to look at the quality of the institutions themselves who are backing a particular issue. If you believe they are of your kind, that's another way of doing research. You could write, there is nobody who has gotten it cheaper than you would. You all start from the same line is one way of looking at it. But that said, I completely agree with Mr. Prabhakar. You need to understand a business, understand a management before taking any long-term call. before taking any long-term call, and the DRHPs and all of this happen in such a rapid manner that even large institutions get a total of like 1 to 2 hours of interaction time. 1 to 2 hours, what will they understand? Any kind of projections get made, a sudden jump in between, and that justifies the valuations. Very, very difficult. In terms of our investing, in terms of institutional investing, well, in the West, IPOs are a source of alpha. Mutual fund managers, other institutions cozy up to the investment bankers so that they get allocation. Okay, it's a source. IPO media and I make more money. In India, it's not a source of alpha.
Correct.
Look at it this way: you need to have cash first. For having cash, a large fund has to sell. There is an impact cost he suffers while he is getting out of something first. Then he has to maintain cash for some time while the rest of the market is moving up. Then he invests into an IPO. He gets 1/10 if he is lucky. Otherwise, usually 1/20th of what he has bid. Because in India, in the normal category, people get a percentage of what they have bid. And then even if the IPO lists at 100%, 1/20th of what you have got does 100%. Rest of the money you get back, you have not generated alpha. It's hell of a lot of effort gone waste. And I think for HNI investors, again, with financing costs put in, we are looking at what makes losses in terms of the issue price. What makes losses in terms of financing cost is an even higher percentage. So I really don't understand why and how this frenzy happens. The fact that it does result in getting new investors in is good, is positive structurally, long term, etc. But I simply can't put a hand on why it happens, how it happens, especially now that even for secondary market trading you could get loan against shares and all of that. It's not financing which is driving it.
Correct.
But anyway, good companies get listed is a good outcome of whatever is happening.
Absolutely. Now, towards the conclusion, just one question to Mr. Prabhakar. There has been this raging debate, so to say, about the two classes of investors who would essentially come out to invest in an IPO. One is the traditional side of the investor, who would look at financials, who would look at the operations, the guidance, and the cash flows, importantly, that the company makes. And the other side of the investor is the millennial side, for who the concept is all it takes for them to really go forward and invest in any particular company. We saw the concept companies coming to the market, getting listed very recently in this IPO phase. Mr. Prabhakar, which side do you justify as far as the right approach is concerned? And more importantly, which side do you find yourself?
In this also, there are companies which are great bets for a very long term. There is one recently listed company where I feel they are going to service the EV market, where the growth is going to be 30% CAGR in the next few years, because it is more of EV, electric vehicle market. And with more electric vehicle companies going to come in, it is going to get a great market share. But valuation is not cheap. But somebody who is looking for a long term will get some good returns over there. So no, there are good companies. There is one chemical company which is listed, agrochemical. I see a lot of growth prospect. So it is case by case, where you take it. But see, I have come hard way. So for me, I'm very conservative. So if for me, it is not about making money. I don't want to lose my capital first. So capital protection is more important than making money. So I'm okay with making 12%, 15% CAGR return rather than making a huge return. So I get into stock when there is a correction, or when I feel the growth is going to be very huge, that kind of potential. So I slowly accumulate. So for me, saving my capital is more important. That is how, when I came into market, that is a lesson I've learned. Today, it is easy money. So people don't understand value of capital. it is okay. They will learn it very fast. But for me, capital protection is important, so I'm slightly or more conservative investor in that category.
Okay,
Yes, actually, you got to answer. Yes, you got to answer of what your debate started. You want to ask that why institutional investors are not able to understand what retail is understanding. Now he has given a real answer that conservatism is what I think, and the past experience, is what actually driving the people to become more conservative. New generation don't know the value of capital. It's a very, very valid point. I think he made it.
I think easy money is sort of we can talk about it as being the problem. We can talk about it as being the advantage for the markets in whatever way you want to fix it. But as we conclude this, an important question to all the three panelists. All three of you have spent good amount of time in the market. A 25-year-old, a 28-year-old listening to you. Prateek, to start with you, what would you tell yourself about market, about one tip about the market to a 25-year or a 28-year-old Prateek Agrawal?
I was somebody who was very, very interested, even while I was in college and did all kinds of research, built a huge book at that point in time, and did start to invest as soon as I joined work. That's the time when you are young. If I recount my days, I was getting $5,000 a month as salary. So what we could lose was $5,000. In retrospective, I am telling you, at that point in time, that was the world. But the risk-taking ability is huge. Learning while you are taking risk with information, with research is the way to go. This is not something which you can learn from the sidelines. You can't learn to play cricket by commenting on it. You have to go, field, wicket keep, bat, only then will you learn cricket. So you have to depend. And when you are starting on your journey of life, getting in incomes, is when your risk-taking ability is the highest. So either you decide that this is not for me, I will give the money to professionals. But if you wish to do it yourselves, and the world over people do it, so it's not wrong. I told you 50% of Americans invest on their own. So why should Indians not? So if you wish to do it, that's the time to start. That is when the learning ability is the highest. You have a lot going for you. My sense is, look at what you and people like you are doing. Chances of you being successful is very high. We look at you to learn what you are doing. You are the future. We are past. So, just look around you and you will be successful. That was the example I gave. One old guy today made a lot of money, buying Coca-Cola because he drank Coca-Cola. Today's generation does something else. That is what will prosper, not what we did, what you guys will do. So, invest there, learn about it. You should be good.
Okay. Kotak, Mr. Kotak, what would you tell 25-year-old yourself?
So when I was 23 and just passed out of CA, we didn't have the online annual reports and BSc and NSE site providing us annual reports. So I used to literally go to the Raddiwala and pick up 700 balance sheets and put in taxi and keep at home and then read one by one. So I think that is a journey we started. The summary is very simple, which I started with the worship. It's about the sadhana. It's about the learning to the end. You don't need to learn the tricks of the trade. You need to master the trade. If you don't understand, don't get into it. Just give it to the professional managers. But if you're taking as a side profession, you are practicing CA or your audit CA or your corporate CA, but I think just take as a para profession, just spend time on it because it's about your money. And you have as he rightly said, Prateek rightly said that you have best risk appetite at that point of time. So in a way, you have opportunity in front of you. I'm seeing Indian equity or Indian GDP going fly high in next many years. Even you take 7% CAGR or 6% CAGR, we have huge amount of opportunity. So I think we are young country and we have enough opportunity to make money in equity market over a long term. So, but do your bets right, do your work hard on what you're doing. It's about money. You cannot just do the, apply to IPO just by knowing something or just listing something. It's about you have to put your own groundwork, before you put your hard-earned money. Yes.
Mr. Prabhakar?
Yeah, I think both of them have answered it mostly. Now, when we entered, really we didn't have any data. Now today data is available. Now, so today in the last 3 days, total results which has come is 360. So reading that will take 3-4 days. So no, that is the kind of data today which is available. We need to work on what stock or sectors we like, and if we can read and what is going wrong, what is going right. If we can understand that, then we will reduce our mistake. Now, see, even the best expert, I think it is not what is working. No, we should first understand what is not working, why it is not working. Now, if we can reduce our mistake, I think automatically we will start making money. So that is the important thing. But without taking risk, you will not understand how to take risk. So invest wisely, but do your study and spend more time on data which will help you for a long period of time.
Okay, thank you everybody. We've of course got a lot of wisdom in terms of various asset classes, investment theme as a whole, and I'm sure a lot of new age investors would be looking at all these aspects of the market before they take their first step, and I hope they do so. Thank you so much.
Thank you all. I request Ash to take the question. Yes.
Yeah, before concluding or starting question, my questions to all the 3 panel speakers is, Prabhakaran sir has rightly said the preservation of capital is much more important than getting return. But sir, at the young age, youngsters has to take risk. So what are the points they should take in mind before? Because risk hai to isk hai, or risk hai to reward hai. There is no reward without risk. So if youngsters want to take risks, what are the precautions they should take, or rather I can call it, what calculated risk they should take? Questions to all the 3 panelists.
Yeah, so let me go first on this. What Prabhakar said is very important to us as a firm. When we talk of what we do, we say preservation and growth rather than only growth. And to all the listeners, find out one rich guy who has been reckless. There is none. So पैसा वहीं ठहरता है जहाँ पे conservativeness हो, जहाँ पे preservation is the first thought. So that is super important. But at the same time, you have to take calculated risk, because if you just talk about preservation and then you put money in a bank fixed deposit, which is the most conservative of it all, you will get 3, 4, 5%. You put money into a mutual fund debt scheme, you will get 1 or 2% higher. If you wish to do a bit more, then you come to equity markets where the degree of risk is higher. But then, what we do is to start with a philosophy. And our philosophy is very simple. Look at a business which is able to compound its earnings, its cash flows in a non-dilutive manner deep into the future in as smooth a manner as possible. The smoother it is, the better it is in terms of us. So 100 rupee EPS goes to 120, 140, 160 is music to us. We want to focus there. The higher the percentage of growth possible and the longer the tenor of growth possible, the better it is for us. You guys have learned finance in CA, you have learned DCF, you have learned IRR, and hence you will be able to associate with this. When you go out in the market, do not lose the link with what you have studied. ऐसा ना हो कि CA आपने पढ़ा और फिर आप एक अनपढ़ ब्रोकर को फोन करके उससे अगली टिप पूछ रहे हो, वो मत करना. Now I will tell you one more thing. Why we do this and why it works is for all of the people in the panel. There is one business which is doing this 100, 120, 140, 160. And there is another business which does 100 and then 200 and then maybe 120, maybe 80, maybe 60. You guys decide in your minds how will you trade the first one versus the second one. We all know we need to be long term in investing so that the cash flow compounding works for us. It works only in the first kind of companies. In the second company where 100 becomes 200 and then drops to a 80, how will you trade? You will not want to keep it for long, right? If you keep it for long, the best part has happened. For 3 years, 4 years, it will be sub that year's number. So you won't be long term in the second kind of company, while in the DCF, the second kind of company may result in a higher number because 100 to 200 is happening in the first year. So your DCF value in the second one could be higher. So these are the small things that we have learned, and we want to follow it, and follow it with a discipline which is of the highest order. Yes, we can make mistake, but the mistake may be in the longevity of growth, maybe with one name of the portfolio rather than all the names. And this is the only part of the market where you can be invested for long term, where the earnings itself are cyclical, and in these times when businesses, like Prabhakar said, changes, what was there in the index 20 years back is not there today. In the US, GE is the only company probably which is there in the index. Everything else has changed. So being long term with the other kind of businesses is wrong. Don't be long term in a wrong kind of business is the key thing that I really want to say. And by doing what we are doing, I can demonstrate to you we are able to deliver both preservation and growth. So if you look at a name like an Asian Paints, HDFC Bank, Pidilite, over last 13 years, starting from the year of the GFC, every single year these businesses have made a new all-time high. And I'm giving you just the name that you guys will know. There are many others. Okay, if you build a portfolio of those kind of names, always take a portfolio approach. It could be a portfolio of 7-8 names, it could be a portfolio of 20, it could be a portfolio of 30. Don't over diversify, but diversify. And of these kind of names, chances are you will achieve both preservation and growth, sizable growth, mid-teens kind of growth, and versus others make money. Now, in the end, just one more line. Lot of times in our business, people talk of what went right for them. First, ask them what went wrong for them. Because in the end, the NAVs of everybody is known to everybody. And the CAGR growth, hence, is around 15% only. So, जिसको बोलते हैं कि आप मंजिल तक पहुंचे, खड्डे वाली रोड पे बैठ के पहुंचे, at a brilliant one period and then fell into a deep hole, or you went in a smoother way is your choice. So, have your philosophy. You are all very well educated. CA is not an easy exam to pass. Write it down, stay disciplined, follow it till the end. You will be fine. You will make money.
Prabhakar, sir.
So
See, what has worked for me or what has worked for other two panelists might not work for somebody who is coming new. So each one has to find what is their strength and what is the kind of person we are. That is also very important. So for example, I buy only the leaders. I don't go below number 3 because I think leaders number 1 and number 2 they normally consistently grow. That is what the record is saying. So no, I don't buy the 5th or 6th player. So I avoid it. So like that, I have created my own rules. So no, they have to create their own rules. But the mistake what people do is when a sector is in hot seat, then they buy some company where the name is there. For example, if there's a sugar sector, if sugar comes, they buy. They don't go deeper and see what is the market share, what is the debt. What is the growth they have had in the last 10 years, 5 years? So if you can analyze that and if you can understand Now, where they stand in the sector, then it will be better. Always have a rule and play with the rule. And if the rule is not, if you make mistake also, you can amend your rule. But what has worked for me may not be work today for the younger kids, because the way we have done it is entirely different. Today, Zomato, where they are growing top line by 36%, and the stock is jumping, where they are saying they will make profit after 10 years, they might or they may not. So that is very difficult for me to digest, but it is okay. Now today investors are different, and they can take that kind of risk appetite.
Okay. Kotak sir, your first and final review.
Good to see Manish. Good to see Manish bhai also on the video. So hi Manish bhai. So I'll tell more in a kind of household language. I'll make it more simpler. So one thing is, whatever excesses happens in the world, whichever area, whether it's stock market or even on earth, it has to come to mean reversion. So that's the one very, very basic message. Second, you have to work very hard for your money to work hard for you. So it is not easy. That's the point number two. Third, I want to put it is that as a CA practitioner, I know I pay my CA fee for my individual file 25,000 rupees. He works very hard, put in tally, do the audit, do the computation, balance sheet, whatever, and then put it to site and finally get 25,000 rupees after a lot of hard work. If it is so hard, then why stock market is so easy? That's another question which I leave it to you, and you can think over and then work on that. That's the one other thing. So you need to see that finally you have to work hard to earn money. Sometimes you're lucky, you get much more money, and sometimes if you're with the leaders like Prabhakar rightly said, you end up doing very well in the long term. Last very important, which I see in my house, and I'll try to leave it to you. Maybe it was for you or not. When I go to buy vegetables, I go sometime once in a month or so. I go to that vegetable wala or fruit wala and I say, "Mujhe 2 kilo apple de." Then I don't care about it, what is putting inside and all that, or bhindi, 1 kilo bhindi. Then I just put in well, I don't know how to choose that bhindi or apple or something. But I've seen when I go with my wife, she actually picks up herself, and that happens to every house, whether you're billionaires or millionaires or everyone, because they're expert in the subject. And they pick and choose what is a good quality, and then they go to bhaiya, and then they'll count. So they are so meticulous about each and everything in that aspect. So I learn from that always that you have to be meticulous and very process oriented about what you do. Errors are part of the game, and you very rightly said, Jitu bhai, risk hai to ishq hai. At a young age, 25 saal ka aadmi risk le, 55 crore hum log thodi lenge 50 wale. So it is actually a time for them to take a risk, but understand the risk. Because risk is a very easy word. It's you have to understand, do a lot of work behind that, and be meticulous and process oriented in what you're doing. If you follow the same method for long term, you are 110% going to be successful. There is no way you can be unsuccessful. That's my little advice. Thank you.
Over to you, Madhi.
Ashish, do we have any questions from the attendees?
We have
running short of
but I think were answered during the panel discussion. What are the
questions are already considered in panel discussion?
Okay. Before concluding the session, I'm thankful to the Manish ji, Drishti madam, for giving us the opportunity to be a part of this webinar series, and I would request Mayur Mehta to give a formal vote of thanks to the panelists and the moderator.
Today's panel discussion was indeed a great learning for identifying the factors which should be considered while making investments in the market and how to manage the wealth, particularly when it comes to stock market. At a very young age, we have learned a lot from all of you guys' experience. On behalf of WIRC of ICAI, we are very much thankful to all the panelists for sparing their valuable time, Mr. A. Prabhakar, Mr. Prateek Agrawal, and CA Vikram Kotakjin. We are also thankful to Mr. Yash Jain for fantastically managing the whole session. So we have learned a lot from all this discussion. Thank you very much.
Thank you. Thank you for having us.
Thank you so much.
Thank you. Thank you.
And may I just add that without Jitu bhai's efforts and I think coordination from all the coordinators here, this seminar in this form would not have been possible. So I would really like to give a heartiest vote of thanks to Mr. Jitendra Khandol, who has worked tirelessly for putting this together. Thank you.
Drishtiben, I want
Thank
to
you
add
to special thanks to Yash Jain also, I would say. At last moment he agreed 2 days before to be a moderator of this panel, and he has prepared himself and done everything. So really thank you very much, Yash, for taking up this.
No, thank you, Manish bhai.
It's
always
Jitu bhai, like eating equity, drinking equity, and sleeping equity. I know that.
it's always
Vikram bhai, you are always helpful to the institute. We know that.
Thank you, Manish bhai. Always at your service. Yeah, thank you.
और एक चीज एंड में मैं और कहना चाहूंगा कि भी जितने भी एफर्ट्स हम कोऑर्डिनेटर्स ने किए हैं उतने ही एफर्ट्स मनीष भाई एंड दृष्टिबेन they are with me since last 3 months to fully organize and smoothly organize this full 4-week series on. So I really thankful to Drishtiben and Manish bhai the way they have given chart to us to make this program very much successful. Thank you Drishtiben, thank you Manish bhai. Thank you. Thank you. चलो, see you. चलो मनीष भाई मिलते हैं. See you next time. चलो, bye. मिश्रा जी, close the session.